Over at the ECB, not too much sustainable impact on the currency there. Yen weakness certainly a theme. Yuan weakness also really a theme. The PBOC has been trying to support the currency. 3 days they put in these aggressive fixes. The market seems to have pushed through those. The focus on the BOJ continues next week, our colleague Mark Cudmore tells us. We're seeing reduced demand for German 2-year debt, and we're seeing those yields going a little higher. No surprise, Tom, on the back of that North Rhine-Westphalia inflation print, which pushed higher, unexpectedly perhaps, in many people's view, this morning when we got that. That's going to be a focus as we build through the day as well. What do futures look like?
Well, that German data reinforces the message coming through that came through from the ECB's Christine Lagarde. Will the Spanish CPI that comes out in the next couple of seconds do the same? We're on watch for that. DAX futures pointing lower just by a smidge. FTSE 100 futures down by a tenth. CAC futures, though, over in France, pointing higher by a tenth of a percent, 7 points. Anna.
Okay, pretty flat then in terms of the futures picture, unconvinced in either direction, maybe. Let's have a look what European equity markets end up delivering then this Thursday morning. The FTSE opens and it is pretty flat this morning, 0.01%, so look really, really hard to see any movement there. This is the strength in the dollar that we've got this morning. I mentioned weakness in the yen, weakness in the yuan, both of those themes coming through pretty strongly from the Asia session. Here's the euro not doing all that much, the pound not doing all that much. The Australian dollar, really interesting as we head towards an RBA meeting in the week ahead. That because we had, of course, that CPI print which made news, and then it was really weak, and then we had the number coming through on retail sales today, which pointed in the other direction, adding some excitement perhaps around that RBA meeting. Broadly, then we're flat to positive actually across these European equity markets. Tom, we were mentioning the German inflation print. We're going to get that later. Let me just linger on the Spanish CPI number. We just got the Spanish preliminary June harmonized CPI number, rising by 1.6% year on year. The estimate was 1.5%. Well, the markets focus on the fact that that was higher than expected, although it is quite a step down from the above 2% that we had in the prior period. And that is a Eurozone inflation print. It's the lowest in the Eurozone, and it's a print below 2%, below the ECB's target. Of course, they focus on the whole Eurozone, not just on Spain, but, you know, we take what we can get in terms of bringing the inflation genie or putting it back in the bottle. What do you see, Tom, on sectors?
Well, we take what we can get when it comes to interest in these equity markets. It's standing out in the auto sector. You can thank Renault for that with the upgrade in the guidance there. 0.6% for the auto sector, the standout in terms of the gains in what is otherwise a pretty modest picture, certainly in the first few seconds, you said, for this open. On the downside, you're not seeing significant pressure in any sector. You're seeing a bit of a sell-off in technology. That is currently down a tenth of a percent. The Micron story, a little bit optimistic in terms of the potential drawdown of inventories that's been so essential in terms of the focus, particularly when it comes to memory chips. But tech as a sector in Europe currently down a tenth of a percent. You're seeing a little bit of pressure on industrials, and travel and leisure down 0.2%. In terms of the upside, that's coming through again for autos, now up 0.7%. Utilities gaining 0.2. Banks also gaining 0.4% as yields tick higher. Anna.
Okay, let's delve deeper into these markets. Sophia Horta-Costa joins us once again from the Markets Today blog. Sophia, let's focus on the European inflation story. We've been watching the German picture build through the morning, or we are going to. We just had North Rhine-Westphalia so far. But the Spanish inflation number, it just broke. And as I mentioned, it came in at 1.6%. That's incredibly low for Europe, isn't it? And it's much lower than the 2.9% we've left behind, but it's a little higher than expected. How are you looking at that core inflation story? Because that's what a lot of central bankers are focused on. We saw that in Sintra.
Yeah, exactly. And actually, the Spanish government has been saying that the country itself doesn't need more interest rate hikes. But that's, you know, as you said at the open, that the ECB looks at the Eurozone as a whole. So we do have this disparity between countries, between Europe's largest economies. Obviously, Spanish inflation is a lot lower than Germany's. We saw Italy's inflation slow yesterday to a 14-month low. But Christine Lagarde really reiterating in Sintra that inflation is sticky. It's still a concern, and they're looking at the picture on a meeting-by-meeting basis. So when asked, what is your terminal rate going to be? Are we going to expect any interest rate cuts in March 2024? She said no, and she's very kind of really trying to guide the market that the fight against inflation is very much not over, even if we see some softening in some core economies like Spain.
And we're seeing some yields tick higher in Europe this morning in echo of what you're suggesting there, Sophia.
Yeah, on the inflation bit, it's interesting because one of the concerns of last year was that China was going to come back with strength. It was going to lead to higher inflation. It was an inflation risk for Europe, but that hasn't happened. And inflation in China is soft and soggy. It gives policymakers the room to get into their toolkit and support the economy. But so far it hasn't happened. And you are outlining the case for kind of lackluster assets in China. We're seeing that at play.
I'm so glad you brought that up, Tom, because it was the one thing that people got wrong about the global economy was that the reopening of China's economy would be inflationary. And it really hasn't been. The soft demand in China, I think that's been much worse than expected. You're seeing that in commodity prices. You're seeing that in oil. Oil and copper, they're actually a lot lower than they were last year. But that's not really going to improve. We actually have a deflationary picture in China. China is exporting deflation to the world. Factory prices are very, very weak, and that's a function of destocking. Factories have to cut prices because of all this kind of excess inventory that they built up during COVID, and that's still happening. But the fact that China's economy wasn't kind of the big boom, the big consumption boom that we saw in Western economies, I think that was really, really surprising to a lot of economists looking at the global picture. Whether that's good news, it could be good news because we're not getting inflationary pressures from China, but we're also not getting demand.
Yes.
So there's kind of a game.
Sword.
Yes.
Yeah, all those Western businesses that have built their futures on trying to sell to the Chinese consumer. Thinking hard about that one. Sophia, thank you very much. Sophia Horta-Acosta from our Markets Today blog. You can get more from the blog team. The front page of the Bloomberg UK website will take you there, or you can type TLIV GO on the Bloomberg terminal to find the Markets Today blog. Now, here are some of the things that we're watching out for today at 8:30 a.m. The Riksbank, that's in 25 minutes' time. The Riksbank, Sweden's central bank, of course, will deliver its latest rate decision. At 9:30 a.m., we'll get fresh data on UK mortgage approvals. A lot of data on the UK housing market this week at a crucial point. Later at 1 p.m., we'll get the German CPI print. The picture regionally builds through the day. That is expected. This preliminary reading will show inflation increasing in the month of June. We switch to the US at 1:30 p.m. When we'll get an update on first quarter US GDP. That print is a third reading. We'll also get US initial jobless claims because, well, it is Thursday, and that's what happens on a Thursday. Tom, so I don't know, wait, our focus is certainly on the Riksbank, isn't it? 25 minutes from now.
Yeah.
Real weakness in the krona, record lows in the currency, so they're having to think about that as well as where their inflation fight is. And of course, the two things are to some extent linked. But the property market in Sweden, a real poster child for weakness in property markets in Europe.
Yeah, and on the equities front on that story, we've been focused on SBB, the impronounceable Swedish company that's at the heart of that real estate pressure. So the expectations, you say, the Riksbank, they're expected to go another 25 basis points. Bloomberg Economics thinks the terminal rate for them will be about 4% because they have to weigh up that weaker krona versus the pressure on the housing market. But it is interesting because of those factors.
Yeah. Okay, coming up on the programme, we will get to a debate around the US equity outlook. That continues, of course. Our next guest points to greener pastures elsewhere. We will ask him why. This is Bloomberg.
Are facing some tough challenges. Higher living and education costs and wages that aren't keeping up with inflation are making it harder for them to support themselves. And they're relying more on the bank of mom and dad. A new bank rate report shows nearly 70% of parents with kids 18 and older are putting their own finances in danger to help them. About half are dipping into their emergency savings or delaying paying off debt, while 43% drain their retirement funds. So where do you draw the line? There seems to be a generational gap. as older parents can't understand why being self-sufficient now is a lot harder than it was for them. Gen Z seems to think on average that 22 is a benchmark for covering the expenses, while baby boomers say their adult children should pay their own way closer to age 20. Either way, it's a family decision. Bankrate suggests having a conversation with your kids and setting a specific dollar amount or time frame for footing the bill.
From the world of politics to the world of business, every weekday at 5 p.m. Eastern Time, hosts Anne-Marie Hordern and Joe Matthew alongside Kaylee Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power, every weekday at 5 p.m. Eastern Time, only on Bloomberg, your global business authority. In a multi-trillion-dollar industry, there's a lot of ground to cover.
We indeed have a rally.
We're talking a lot of dividends. We're talking income.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg. When U.S. jobs numbers are released, Bloomberg brings you crucial data at terminal speed and instant expert analysis. Nobody covers jobs day like Bloomberg.
This is Markets Today. 9 minutes into the European trading session, you're seeing very modest gains of 0.1% across the European benchmark. The FTSE 100, though, is just down by 2 points. Futures in the US, the S&P E-minis are flat. Across your sectors, at the bottom of the list, travel and leisure here in Europe down 0.7%. Retail, though, is leading the gains, up 1%. Let's get a check on some of the individual stocks with Joe Easton. Joe, what is moving? What's in focus for you?
Absolutely. Morning, Tom. So we're going to take a look at some of those stocks that we had on Stocks to Watch a few moments ago, and they are all higher today. Renault getting that jump following some positive sales guidance, looking at their EV business and also some new models, including their SUV that is selling really strongly. Meanwhile, H&M boosting those retail stocks, as you mentioned just now, one of the best performing sectors. That stock rising as much as 8%. They have seen their sales growing in the last quarter despite some concerns around the winding down of their Russian unit and also some poor weather at the start of the year. But that is boosting the sector. Meanwhile, Ipsen up 6%. We mentioned this one. This is the rare bone disease drug company. They've had some surprising backing from the FDA about that drug, and that has beaten analysts' expectations. That is the best performer in Paris, and that's why you watch Stocks to Watch every morning. All those stocks higher. I've also thrown in Kering. This is, of course, the parent company of Gucci. That one falling today after a downgrade at HSBC, who had a buy rating on that stock for more than a year. They've cut it to neutral this morning, and that one is falling in Paris. We're also going to take a quick look over at the chip makers following that news from Micron. These chip makers opening up a little bit mixed. ASML was slightly higher, trimming those gains. This is as Micron does say that its sales outlook continues to be upbeat, but they are seeing some supply issues over in China, so that could perhaps be dampening the sentiment for the European chip stocks, but those are ones to keep an eye on in the tech space today.
Joe, thank you very much. Prompts me to look at Nasdaq futures, pretty flat actually, flat to positive on E-minis, Nasdaq futures and Dow futures this morning. Thanks to Joe Easton for an update on some of the early movers, 11 minutes into our European session. Now, the yield on 10-year bonds has climbed after Spanish CPI data came in hotter than expected, but crucially fell below the ECB's 2% target. The next read on inflation comes at 1 p.m. UK time, at least a national read. That's from Germany. Numbers released earlier from North Rhine-Westphalia, that region, the country's largest state, of course, showed a 0.5% point increase to 6.2%. So perhaps in the views of some, an unexpected tick back up in the inflation impulse out of Germany. That and the number out of Spain, perhaps pushing yields a little higher in Europe today. Joining us now, Stephen Whiting, who is Citi Global Wealth Chief Investment Strategist and Chief Economist. He joins us here on set in London, and we're very pleased to have him. Good to speak to you then, Stephen. Thanks for coming in. I know you've been traveling a lot, touring a lot, and maybe we'll get to what your clients have been talking to you about in just a moment. But just to focus in on the inflation story, because we've got this print from Spain today. I mean, it's down at 1.6%, which is a lot weaker than other parts of the Eurozone. But we're not through the woods yet, perhaps, as the German number reminds us. What are you thinking about when it comes to the core inflation story in Europe?
I think that it looks very much like the core inflation story that you see out of the United States. These on a chart would look quite similar. We've had similar internal trends The goods sector having a big boom and then a little bit of a bust. Services sector picking up and turning on, and this kind of demand instability moving from one sector to another in rapid fashion is not consistent with price stability. But it's not something that monetary policy can do very much about either. And it's a strong lagging indicator. Services, for example, services prices in the U.S. is a member of the index of lagging economic indicators. So if we take a look at where inflation was a year and a half ago, in the U.S., it was 9%. We're here in the U.K. It's recently been close to 10. But these readings now are coming down as rapidly as any other period following a global shock and a period of sharp monetary easing and tightening.
So, I mean, I'm just squaring that with the comments that we heard from officials in Sintra yesterday on the stickiness of core inflation and their determination to have to do more to get that down. Do you think, how do you look at the mismatch between the commentary from Fed officials and what we're seeing in the equity markets?
I think it will generally be a mistake if we end up tightening proactively for the future when the lags for past monetary tightening have not been allowed to play out. Now, whether it's a big mistake or a small mistake, we'll see. Certainly having a zero policy rate or negative in the Eurozone for the period into 2022 was one of the mistakes. We had 25% money growth in the U.S. In the year 2020, and this contributed to a great deal of inflation up until this recent period. But it's not like that. If you take a look at M1 in the Eurozone, if you take a look at M2 in the U.S., these are negative 5% declines in broad money. And it's telling us that inflation in the next 2 years is going to slow rapidly.
Yeah, okay. We'd had a conversation yesterday about whether the Fed and central banks have done enough to certainly on the housing market context in the US. Let me ask you about your talks with clients then, and you've been traveling a lot, Stephen, and I wonder what it is that clients want to talk to you about right now.
They consistently around the world, they're waiting for that one moment when all macro risk is passed, when there is the collapse.
Does that happen?
The economic, well, if you take a look at 2020, again, is the most recent experience. The U.S. had a negative 30% quarter for GDP, then up 35% in the following quarter. Unemployment was 15%. It could only go down. That's the kind of decisive period where you have share prices, you know they've reached the bottom and they can only go up. This is the kind of environment everyone wants, but we're not going to get. It's very unlikely that this particular economic slowdown, which is going to be probably fairly prolonged, which involves some industries contracting, others growing at the very same time, what we'll call rolling recessions and below-trend growth, it's not likely to give a all-clear signal where everything is over with. But importantly, some of the things that happen in recessions, clearing inventories, disinflation, these things that can pave the way to stronger growth, and it'll take some time, these are happening. And if you're waiting for a recession, some industry data, again, very clearly shows that we've had a recession. If you take a look, again, at single-family housing, if you take a look at construction and trade, manufacturing, these are industries that are contracting right now. It's not out there in the future, it's happening now. But it's not the entire economy because of these COVID distortions to services rebounding.
So if we're not going to get that clear-cut moment,
yes,
what is the call around positioning? I mean, do you have to look at some of the themes, whether it's the AI theme, do you have to look at themes around, or at least markets out and beyond the US to look for that upside?
Certainly.
What is the call around positioning?
All of those things, but the main thing is one cannot simply say, well, I'm going to be an investor tomorrow and I'll simply be, someone holding cash. And then if you think about returns, again, for broad portfolios have been about 9% this year.
So you need to be invested in equities still?
You need to be invested, again, generally in stocks and bonds. And again, the things that were harmed.
So do you have a preference, bonds versus stocks?
We're a little bit more optimistic right now in our weightings in fixed income. We think that the revaluation has been sharper there. I would take a look at U.S. large caps at, closing in on 20 times earnings and say, okay, there's a good deal of optimism. Global stocks, ex-US, 11.5 times earnings. Think about that. There are markets that are trading with 7 PEs, 7% dividend yields. There are those things. And in the U.S., when you had this massive rise in a few shares associated with AI, In a real bull market, that would have spread to everything. New ages. We don't have that kind of confidence. So what we have is some leftovers where there are valuation opportunities if you go down in market cap.
So if you're going down in market cap in the US and you're going overseas for stocks as well, does that take you to a cheap China market?
It does, and obviously it's a policy question. It's one portfolio component. It's very, very clearly dependent on restoring confidence of the business sector and consumers in China. But this is an economy that has widespread unemployment, that is deeply depressed, has had a true collapse in its housing sector, and has industrial deflation. So it's just the opposite of the United States. If you think about constructing portfolios, don't put all of your money in one country, right? Think about the fact that you can have some different valuation and business cycle dynamics, again, if you invest across the world, that has not paid for U.S. investors or international investors looking at only the American stock market over the last 10 or 20 years. Now the U.S. stock market is 62% of the global index. It's trading at record high valuations relative to the rest of the world, and that is, mostly in defensive large cap equities. Again, our largest overweight last year was pharmaceuticals, playing defense. So that very story about, I don't want to be an investor until the timing is perfect, has also spread to very crowded trades in defensive industries. And that's something that, again, we need to now listen to our clients and say, it's time to not be so defensive.
Okay, Stephen Whiting, thank you very much indeed. Citi Global Wealth, a chief investment strategist and chief economist, maybe calling for a bit of exposure to Chinese equities, certainly overseas, and look beyond the US markets. Also quite likes front-end, short-dated debt as well for some opportunities in this market. No clear cut in terms of a decisive moment on the macro front. Coming up, Britain's largest water supplier is drowning in debt, and the government is considering a rescue plan. We dive into the details next. This is Bloomberg.
tag on the product may read Made in the USA, but the sign on the CEO's door often says Made in India. Alphabet's Sundar Pichai, Microsoft's Satya Nadella, IBM's Arvind Krishna, Micron Technology's Sanjay Mehrotra, and that's just the start. Add in the chief executives of Adobe, Deloitte, Gap, VMware, and that doesn't count Indians running companies all over the world. Why have so many Indians risen to the top? Vinod Khosla points to India's incredibly competitive education system. If you can survive the pressure it takes to get into one of the Indian institutes of technology, it gives you confidence to handle American universities and later the business world. Meanwhile, the belief in India's ability to produce so many tech wizards is reinforced every year. Indians make up about 3/4 of the immigrants receiving coveted H-1B visas for the U.S., and it's a safe bet that some of them will eventually find their way to the C-suite.
Bloomberg UK, your source for news and analysis covering the biggest challenges facing the UK government, economy, financial services and markets.
Tax cuts should not be the priority. It's about a credible plan for growth over the next 2-3 years.
In this post-Brexit world, how do you see actually servicing your clients?
It was disruptive, and it's going to have implications to how capital raising works.
Now we're having the perfect storm in the UK.
Watch Francine Lacqua Thursdays at 9:30 a.m. only on Bloomberg, your global business authority. Markets count down in Europe from the financial centers of the world. Bloomberg Markets European Close with Guy Johnson in London and Alex Steele in New York. Real-time numbers, real-time analysis. Weekdays.
This is Bloomberg Markets Today. We are 22 minutes into our trading session here in Europe, and we're pretty range-bound, actually. The CAC 40 perhaps getting a little bit more upside, up by 0.2%, but elsewhere, pretty flat across these European equity markets. Let's turn to one story that's certainly been a big talking point here in the UK. Thames Water bonds tumbled in yesterday's session. That's after reports Britain's biggest water company is in talks with officials over contingency plans, which could include a temporary nationalisation. Here with us is Bloomberg's Irene Garcia Perez. She covers distressed debt in Europe. This seems to show some distress, Irene, so very good to have you with us. So how did Thames Water get into this mess? Remind us of what's been driving this.
So it's been due mostly to poor operational performance because it had to pay a lot of regulatory penalties that have to do with legacy issues because of lack of investment in infrastructure. It has to invest even more yet to implement the turnaround plan, so it needs an equity injection. It has higher operational costs because of inflation and also higher financial costs because of inflation.
Is it idiosyncratic to Thames Water, or is this an issue that's facing the broader industry here in the UK?
The lack of investment it's broader industry problem, although Thames Water is definitely underperforming compared to other industry peers.
Because I think the leverage on Thames Water is higher than it is even in other names in the sector, isn't it? Now, Thames Water's bonds have plunged then. We've seen that. We saw that yesterday. But one plunged more than 30 pence on the pound. Why was that one so in focus?
Because that one in particular is issued by a holding company that depends on the operating companies sending dividends upstairs, to pay those bonds. Now the government changed the dividend rules, the policy that companies can pay, even to related companies. So that may be into trouble in particular if it's nationalized.
I mean, this raises questions about any kind of nationalization, doesn't it? I mean, they come in different shapes. It could be some sort of emergency step to sort of take over things, or it could be a conversation is prompted about longer-term renationalization of this sector. And certainly if we saw a change of government, that conversation might get louder. Rene, what do we need to keep in mind, though, as we think about whether this is a sector that could be renationalized?
Well, I guess we will have to see how they compensate shareholders if in the end it comes to a broad sector nationalization, also what happens with creditors, if they will need to take a haircut or not. And if it's down to just Thames Water, it will also be interesting to see what's a read across to the other companies that are nationalized. How do you fix the issues of the industry in terms of underinvestment in infrastructure otherwise?
Yeah, it's interesting. Irene, thank you very much indeed. Irene Garcia Perez on that story around Thames Water. It's interesting because there's an irony to it, right? They made all these mistakes, or at least they faced fines because they pumped sewage basically into Britain's rivers and waterways. Then they were fined. That worsens the balance sheet and makes it more difficult for them to invest in infrastructure. And you have to wonder whether there needs to be a framework to actually punish, at least penalise those on the board and executives, rather than penalising the company itself to try and stop them from making these.
Yes, and whether we need a check, because that's the regulatory structure they've been operating under, isn't it, up to this point? Whether we need a change in that is certainly going to be a live conversation in the UK over weeks to come. Now, we're just getting more lines coming through from Jerome Powell then, Tom. Let's just revisit that. We have to be ready to follow the data is one of the things he's saying. We've all seen inflation be more persistent. These tying in really with things he was saying over the last week or so. We haven't taken consecutive moves off the table. That was something that certainly came out loud and clear from Sintra, wasn't it, yesterday?
The risk of overdoing tightening isn't in balance yet. The timing and the extent of rate hikes will be dependent on that economic data. So, as you say, reiterating the message that the door remains open for further hikes from the Fed. Coming up, where did all that Russian gas go with Europe cutting off Russian supplies of gas? The country needs to find new markets. We're going to discuss what those markets are and where the Russian oil has gone as well. This is Bloomberg.
world of politics.
We're not going to be relying upon countries whose values we don't share.
To the world of business.
It's all about corporate power in the end.
Balance of Power, live from Bloomberg's Washington headquarters.
We're going to be more excited what's in store for you.
How long will it take? How many years? Why don't we take this one day at a time?
Good luck. Everybody has a perspective.
Every weekday at 5 p.m. Eastern Time. Join host Anne-Marie Hordern.
It's the one area, really, of bipartisanship.
Well, I think we're getting more of it.
That's optimistic.
And Joe Matthew.
The debt ceiling is looming. How close are we going to get to the line before you start to worry?
Alongside Kaylee Lines.
The door was open for regulators to do more, and that puts the Fed between a rock and a hard place.
As they deliver news.
This is such an important economic issue.
He's no longer trying to run away from
that really blew some minds.
Insight.
We can both invest in law enforcement and also make sure that communities feel safe in their own skin.
And analysis.
I think your audience will get this more than most.
This is not the Republican Party that you know.
It allows him to do what he did so successfully in 2020, which is run against crazy.
From and about politics' biggest power players.
This was the zombie case, and it's now more than well alive.
That's for sure, with two more potentially to come.
I'm willing to have this battle.
It is vitally important.
This is the intersection of Washington and Wall Street.
Bringing people directly to the decision makers that impact your investments and your life.
Balance of Power, every weekday at 5 p.m. Eastern, only on Bloomberg, your global business authority.
DOJ or other authorities
Could face bigger challenges next.
Was going to keep rating World Cup. This is a 3.
As the economic picture does.
The BOK is getting ready to make a decision.
This is Markets Today, 30 minutes into the European trading day. Here are your top stories. Back to back is back. Jerome Powell leaves the door open to consecutive rate hikes, with Christine Lagarde and Andrew Bailey also seeing more tightening as inflation remains sticky. Bund yields climb as Spanish CPI data comes in slightly hotter than expected, but crucially falls below the ECB's 2% target. The next read on European inflation comes at 1 p.m. UK time with German CPI. H&M shares the biggest gainer on the Stock 600, with the retailer optimistic on doubling its operating margin next year after posting a beat in second quarter earnings. So, half an hour into the trading day, a lot to talk about from the macro side of things, Tom. We've got, of course, all those central bank conversations going on, and we've got another one developing. I can see a lot of movement out the corner of my eye in the Swedish krona as a result.
Yes, the Riksbank decision coming through then, raising the policy rate to 3.75% as expected, so raising by 25 basis points from 3.5 to 3.75%. Bloomberg Economics, by the way, expects the terminal rate to end up being at 4% by the time that they are done. Riksbank's rate to be increased at least one more time this year. So there's the forward guidance from the Swedish central bank, rates to be increased at least one more time this year. We know the Swedish krona has been under pressure, and here's how it's being reflected. Euro up versus the krona on the back of this news at 11.8. The housing sector, of course, has been under pressure as well. So they're having to deal with those dual factors over in Sweden, a weaker housing market, but a weaker krona as well. So 25 basis points and the move up in rates from the Riksbank to 3.75%. Let's check in on the equity markets, though, across Europe. You've had a little bit of a turnaround in sentiment, well, you had done. You're flat now across the benchmark, but you do have a little optimism coming through from some of the sectors, and we'll break those down for you in a second around autos and retail. The DAX is currently unchanged. The FTSE 100 off by 0.2%. And across the benchmark, as I said, currently flat. The inflation data, higher yields, it seems weighing on the equity markets a bit. The euro has ticked up, and there has been selling pressure across sovereign debt, particularly at the front end as well. In terms of those sectors then, the standout is autos, thanks to an upgrading guidance coming through from Renault. So that's some optimism there. 0.8% is the gain. The banking sector up 0.4%. Maybe that's the higher yield story playing through there. Energy is just gaining 0.1%. And I want to bring you retail as well, because that's front and center now, gaining 1.1%. H&M more positive on its results, and retail now is gaining a full percentage point. Anna?
Okay, let's move away from what's happening in markets right now and talk about one of our big stories of the morning. Much of Russia's existing gas export infrastructure points towards Western Europe. That's where the pipelines go. But since the war in Ukraine, most of its gas customers are now to its east, namely China and India. Now, Russia is sitting on almost 90 cubic meters of pipeline gas with no solutions in the immediate future. Let us get more on this story then with Will Kennedy, Bloomberg Senior Executive Editor for Energy and Commodities. Will, very good morning to you. So the pipelines go to the wrong place, essentially, right now. Tell us more about the dilemma that Russia finds itself in.
Well, I think it's interesting to draw the contrast between oil and gas. As we've talked about many times, Russia has found new markets for its oil, which were in Europe, and now that oil is put on tankers and taken to India and China. Gas is much more complicated, but it requires expensive infrastructure, pipelines to move it. And while there is a pipeline from Russia to China, it's not linked to the greater network, and it has only so much capacity. So you've basically got a good proportion of gas that's now stranded. So if we look at gas production, it's actually now being shut in. Gas production is 13% lower than it was before the war, and the hit to revenues has been even bigger. So for the government, they're getting 45% less revenue from gas than they were in the same period last year, and that's because a lot of that revenue came from exports. So it's a big problem for Russia, and there aren't many easy solutions. While they're pressing to build a second pipeline to China, China's been pretty lukewarm on that prospect.
So has the Kremlin been able to make up for that drop in gas revenues with sales of oil?
To some extent, but not wholly. I think that revenue for the Kremlin is under pressure across hydrocarbons. The problem they have in oil, of course, is that the price cap and reluctance to buy Russian oil for people who are outside China and India has suppressed the price that they're getting. So they're under pressure across the board.
All right, Will Kennedy, Bloomberg Senior Executive Editor for Energy and Commodities, on what has happened to that Russian gas and the prospects, of course, of oil and whether they can make up the revenues on the back of oil sales to countries like China and India. Well, thank you very much indeed. I was momentarily distracted because we've got some lines dropping from the Fed Reserve Chair, Jay Powell. Of course, he's in Spain right now. Some more lines crossing as he speaks alongside his Spanish counterpart. Powell saying you should not assume a return to a low inflation environment. Should not assume a return to a low inflation environment. In the near term, central banks are very sensitive to inflation data. That's not a big surprise that he's saying that. We have to be ready, of course, to follow the data. Again, not a big surprise. We've all seen that inflation is being more persistent, Anna.
Yeah, and we're getting lines coming through also from the Bank of Spain Governor Pablo Hernández de Cos, who's saying he is open if there were to the idea that he's keeping it open, whether there will be a rate hike at the September meeting. And this really is just exactly what we heard from lots of ECB officials over the past couple of days in Sintra. July looks to be a fait accompli, I think we were told on the programme yesterday. Yeah. But September, nobody being drawn on September, very different story.
Not even Christine Lagarde would back the idea that that's locked in any sense for September. So the data's coming through. The Spanish print, of course, as we mentioned, coming in slightly above the estimates, but no, despite that, it's still coming down. Spain has a less acute inflation problem than other parts of the Eurozone, of course, and we're getting German CPI data at 1 p.m. UK time. Coming up, the UK's property market is in focus with mortgage costs rising. House prices are lower. We're going to speak with Richard Donald from real estate company Zoopla, get the pulse on the housing market in the UK. Stay with us. This is Bloomberg.
Okay, so you're moving in on me, quick, distracting me with your fancy hands. I'm going to deal with your knight because this is really bothering me.
Ah, my knights.
Yeah, he's a troublemaker.
Yeah,
What did you get up to this weekend?
You know, just robot stuff. A lot of chess. I was practicing for you. I know you're pretty good. Ooh, I don't like that. I will take this. Put it over here.
Not cool. Not cool. All right. I will concede. I can see. You've got me beat.
Very good game. Well played.
Thank you, sir. Thank you.
Japan's critical role in the global economy is changing as the world recalibrates. After decades of stagnation, Japan's leaders are forging a more innovative and sustainable path forward to revitalize the nation. Corporate giants, policymakers, and pioneers tell us how they're doing just that. Every week on Japan Ahead, right here on Bloomberg Television.
This June, in honor of Pride Month and Juneteenth, Bloomberg brings you a special equality series every Thursday in June at 1 p.m. Eastern. Bloomberg Equality, celebrating inclusion this Pride Month.
This is Markets Today. We're 39 minutes into the European trading session. Pretty flat across European equity markets, and US futures not helping us much with that direction. Then we're flat on US futures as well, Tom. E-minis and NASDAQ futures both almost flat this morning. Tom, you've got your morning must-read for us on stocks and how much Jerome Powell cares about stocks.
Yeah, so Jerome Powell, I mean, what I like about this opinion piece by Jonathan Levin of Bloomberg Opinion is that it draws attention to the gap that's widened, arguably, around financial conditions that on some measures are the loosest since February of this year, and the hawkish commentary from Jay Powell and other members of the FOMC. So Jonathan Levin, just reflecting on that speech or the comments from Jay Powell yesterday in Sintra, he said Powell was given a golden opportunity, had he wanted it, to jawbone the markets back into their place during that panel. Not only did he not take the opportunity to do that, but he implicitly seemed to give the bulls the all clear, is Jonathan Levin's take on the fact that there wasn't pushback. He was asked about this twice by the moderator. Is he concerned about the fact that US stocks have rallied year to date? S&P, of course, up 14%. The NASDAQ up, of course, solidly double digits. He didn't push back on that. He said, look, we watch the data and then their markets react. But the reflection from Jonathan Levin is, you cast your eye back to August of last year, Jackson Hole, and Powell came out with a hawkish speech that was seen then as a pushback on the upside coming through from equity markets. He didn't do it this time, and for Jonathan Levin at least, that is significant.
Yeah, you can find that piece by Jonathan Levin under OPIN Go, opinion pieces on the Bloomberg terminal, of course, or under his bio page. A really interesting read, Tom. I liked what our colleague Mark was saying, though, in the last hour of the programme about different time horizons and a focus on financial conditions, because Jonathan's piece seems to suggest that perhaps Jerome Powell is interested in stock markets because of what it does short-term to financial conditions, whereas actually Mark was suggesting maybe he takes a much longer perspective, a long-term view on financial conditions, and that different time horizon is important when you think about whether he cares or not at any one time about stocks. So let's leave the market story in terms of equities to one side for a moment and turn to the UK housing market. It's facing new hurdles after being rocked by the worst cost of living crisis in a generation. Economic uncertainty and soaring borrowing costs also hitting the market. Sellers are having to cut their asking prices. Buyers are discovering their money doesn't go as far, and some homeowners are confronting ballooning mortgage payments. Joining us now, Richard Donnell, who's Executive Director of the British property website Zoopla, and can talk us through his latest findings and thinking. Very good to have you with us then, Richard. Thank you for joining us this morning. So about 15% of sellers accepted at least 10% off the initial asking price. So these are the kinds of discounts that we're having to see at that end of the property market. Talk us through that weakness.
Well, there's just been a real adjustment in the last year almost to mortgage rates going up. There's been some insulation from mortgage regulations that protected consumers, but it's becoming far more of a buyer's market now. There's been a big increase in the last year on sellers just having to keep adjusting asking prices down and then taking bigger discounts to agree a sale in the first place. So we've got slightly fewer buyers on the market than we had this time last year, and they're just driving harder bargains.
Are you seeing a slowdown, a reduction in terms of the numbers of properties that are listed? Is the supply reducing as well as we kind of confront these higher mortgage costs and homeowners decide, you know what, we're just going to stand put until things clear up?
No, supply is growing. I mean, the big story
is growing.
The story of the pandemic was chronic lack of supply of homes for sale. We've now gone back to the long-run average. There's signs that it might keep increasing. We've got more landlords selling up, not just homeowners in the market. And so that's one of the risks to sort of house prices in the second half of the year is we get more supply, more price-sensitive buyers, and that's going to keep that downward pressure on property prices.
Yeah, that's really interesting, isn't it? Our colleague John Stepek writes a Money Distilled newsletter for Bloomberg, and he was saying that exact point, which also surprised me. The number of homes hitting the market in May was 18% higher than the 5-year average. So that's what we're seeing on supply. Which areas then are most affected on the supply side? By this weakness in markets? Is it where supply is responding and we're getting more property coming onto the market? Is it where borrowers have been most stretched and therefore can't remortgage? What's the story?
I think the real squeeze is coming on any housing market with an average house price pound sterling of more than 350,000, 400,000. It's very much a south of England story, and that's where the pressure's coming. Affordability from higher mortgage rates is not damaged as much in Scotland, the north of England, parts of the Midlands. So I think the downward pressure on prices is going to be seen in the south of England and all those markets that really picked up in price over the pandemic.
That's interesting. Is what you're seeing in the north of England then? Is that resilience, and do you expect that to hold?
Yeah, I think so. I think we might see house prices at 0 + 1 in the north of England, and then the price falls are going to come through in the south of England. But even if house prices fall 5%, which is our expectation this year, they're still going to be 15% up on where they were before the pandemic started. And I just think we've got this long, drawn-out period of much lower nominal house price growth as prices are going to slowly underperform earnings, probably underperform inflation, and there's going to be this realignment rather than a huge drop that then we see a sort of rebound later.
Okay, yes, for those with a stake in the UK property market, that last comment you made, Richard, perhaps quite comforting about the fact that even if we drop so far, still up versus pre-pandemic. I spoke to the CEO of NatWest yesterday, Alison Rose, and I was asking her about what is the most popular solution for trying to get through this pending crisis, if that's possibly too strong a word. But she was saying there's a lot more interest now in 5-year fixed. That's what a lot of people seem to be coming off maybe a 2-year fix and looking at. It's as if people who own properties looking to remortgage, they're just prizing certainty. They want some kind of certainty, even if rates might get cut in the medium term.
Absolutely. People, what we saw the housing market in the early part of this year was as mortgage rates fell to 4%, we actually saw sales pick up, pricing started to firm. So the housing market can kind of operate at 4 to 4.5% mortgage rates. We've got 5-year fixes, 5.5 at the moment, so that's taking more buying power out. It's going to keep the pressure on prices. And yeah, people want certainty. The 5-year fix seems to be the most popular. And actually, again, one option people have when they face a repayment increase is to extend the term, and we're not hearing much evidence of people extending terms.
Okay.
Consumers are paying the money and hoping for rates to fall.
Would we ever get to a situation where we get to really long-term mortgages? You were asking about this yesterday. Some other markets, notably the US, have much longer-term mortgages, don't they? Or rather, they fix them. We have long mortgages, but we don't fix for long. They fix over a much longer period. Why don't we do that in the UK?
Well, we sort of hit a high of 60% of people fixing for 5, which was quite unique for the UK market a couple of years ago. Look, I think this needs government intervention and support to really kind of support a much longer-term mortgage market. I'm not sure the markets themselves are going to deliver it, and it's really one for government.
It's our wonderful colleague Alex Steele in the US, who is often on air touting her sub 2% 30-year mortgage in the US, which is just like, blows our minds at this point. You talk about this increased supply. How much of that is down to pressure on households because they just can't afford to remortgage at a high rate environment? Is that what's leading to more supply? And folding in a second question here, are you seeing a tick up, or do you expect to see a tick up in kind of delinquencies?
I don't think so. I think
and repossessions.
The credit quality of who's been lent to in recent years. I think a lot of people forget the mortgage regulations, pretty stringent regulations introduced in 2015. So even though
those are working.
Yeah, even though you had 1 or 2% mortgage rates, people could only get a mortgage if they could prove they could afford a 7% mortgage rate. So there's a lot of resilience in today's mortgage payers. I think the cost of living increasing is going to create pressure. And again, with the stuff with what was announced by the banks and the government last Friday, I think that's going to really reduce sort of forced sales. And I think
although we've got more buy-to-let than we did maybe during the financial crisis, haven't we, in the UK? Isn't that an area of weakness?
It is, and that's what's driving part of the supply story is buy-to-let landlords selling up.
Yes.
About 11% of all the homes listed on Zoopla were previously rented, and half of those sales are in London, the South East, where yields are lowest, and the squeeze of higher rates is going to hit cash flows from investors.
Okay, really, really interesting. Richard, thanks for coming onto the show. Get us the details around the housing market here in the UK. Richard Donnell, Executive Director of British property website Zoopla. We had that increase in terms of the rate from the Riksbank over in Sweden of 25 basis points to 3.75%. The line crossing now that the Swedish krona has fallen, hitting a record low of 11.82 per euro, and you're seeing the dollar strengthen against the krona as well. But there you have the Swedish currency falling to a record low versus the euro. That's despite the fact that the Riksbank came out and said another hike is in the pipeline, Anna.
Okay, that's what's going on with those markets then in terms of the Swedish rate decision. Coming up on the programme, almost an hour into the trading day, we will get more on the markets and break down those European inflation numbers. We've had the Spanish CPI print. It fell below the ECB's 2% target. Of course, the ECB's worried about more than Spain. It's worried about the whole Eurozone, but it's progress nonetheless. Down at 1.6% in Spain now, inflation. This is Bloomberg.
Expensive cities have a lot going for them. But if you live in one, you've probably noticed that these big, expensive cities keep getting more, well, expensive. You could always move away. You might have just started working remotely, so there's really nothing keeping you there. But then again, moving is a hassle. Well, what if someone paid you 10 grand to do it? What if they threw in free office space, a bicycle, or a gym membership? Programs in cities and states around the US are doing exactly that, and they're getting a lot of interest.
We've had over 50,000 applications.
About 90,000 applications.
We've had over 1,800 applicants from all over North America.
So are these nascent programs actually beneficial to their communities and the workers joining them? Or are they little more than flashy advertising campaigns for places looking for an injection of fresh talent?
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
This is Markets Today. We are 51 minutes into our European trading session, and you can see that we're pretty flat across all European markets. A little bit of upside on the Paris market, but not much else to shout about. Tom?
Well, the inflation data that's come out so far today seems to underscore the point that we were hearing from Christine Lagarde of the ECB. And at the ECB forum in Portugal, several of the world's top central bankers, of course, have said inflation remains too high and more tightening will be needed. There were some lighter moments, though, at the conference as well. BOJ Governor Oeda was asked how he was finding his new job, and the jokes just continued.
I didn't know there was going to be so much traveling and so many press conferences. The yen is being influenced by many factors other than our monetary policy, including the policies of these three banks. So we'll see. We haven't had any serious monetary tightening for 3 decades. So in terms of that, the lag in the effects of monetary policy could be at least 25 years.
Okay, Japan's Bank of Japan governor there bringing some wit as well as wisdom to the stage in Sintra. Do you remember Kuroda? He used to have quite an endearing kind of giggle and laugh. But he wasn't famous for bringing the jokes.
We've got the
jokes, I mean, within the context of monetary policy.
Yeah, it's all central banking.
But
so
a way to brought a bit of lightness to the
He did, 25-year lag in monetary policy.
That was a good
That's
one.
hilarious
That was the punchline.
in monetary policy circles.
Let's bring Eddie van der Veld, someone else who's brilliantly witty. Eddie van der Veld from our Markets Live team. I don't know how you're going to match that, Eddie. What are you looking at today? How do you think about, I mean, it is, you know, this weird world that we live in where a way to kind of literally standing and sitting to one side of the other central banks because he lives in a parallel universe.
Yeah, look, it takes a rare talent to make people laugh about monetary policy, and particularly in the current environment, right? It's not really a laughing matter. So the fact that he was able to pull so many jokes, I think that showed a rare talent. But I think what we really saw on that stage, more than just the differences in style, in how, you know, some were very serious, Bailey in particular, and how, you know, he sounded much more light, was, I think, that we're starting to see that divergence creep in across central banks. Sure, we are still seeing a lot of hawkish talk. We're seeing a lot of noise about controlling inflation, but we're also seeing economies in very different places. The UK is still seeing inflation very close to double digits. And then over in China, you're starting to see almost deflation. So we're starting to see central bankers for the first time since the pandemic having to respond very differently according to what is happening inside of their own economies. And I think that is the biggest thing that I've learned from Centra, other than the fact that Ueda is very funny.
It's very funny. We've also got one thing we've learned this morning is we've got quite a lot of divergence, or continue to learn, I suppose, and appreciate about the European story, Eddie. A lot of divergence around the inflation rates. We're down at 1.6% inflation in Spain now. For the Eurozone, that is the lowest. That is really low inflation. That sounds like normal times, and elsewhere, things still feel anything but normal. We'll get German data later.
Yeah, absolutely. And I think the difference that we're starting to see is economies that are very reliant on the manufacturing sector is seeing a lot of weakness. Spain, of course, has a big services sector as well. But in Germany and in places like China, you know, inflation is really coming off because the manufacturing sector is struggling, and the manufacturing sector is cutting costs and cutting what they're charging their customers. So you're seeing that speed through, whereas the services sector is very strong. And I think that's where we're starting to see a little bit of divergence. Of course, if the services sector remains strong, PMI data suggests that it's not. I think that is the big question for the next 6 months.
Okay, thanks very much, Eddie van der Veld joining us there from our Markets Live team with what's happening on the markets broadly from a macro perspective. Tom, just time to check on a few market movers. Let's get to those. We've got Renault on the move. Shares of Renault have been rising after earnings guidance upgrade. They raised their full-year operating margin target to 7 to 8%. They had seen at least 6%, so that's proving to be positive for that particular share price. What else have we got in there? We've got H&M. That particular business, second quarter operating profit came in above estimates. Upbeat results, positive for retailers, so that's having an impact on other retailers as well. I can see B&M in that list on the retail side. They're joining retailers in a price cut push. That seems to be one of the lines that the London Rush team has pulled out.
And then there's the drug maker Ipsen as well. You're seeing a pretty decent pop there, almost 3% on the back of news that they have got the FDA backing for a bone drug. Which is obviously good news for the company, good news for anyone suffering from that ailment. So that's seeing some upside as well. So those are some of the individual corporate stories. Across the benchmark, what you're seeing is you're flat across these European equities. But if you lift the hood, the interest is there. The S&P futures are just eking out gains at this point after a mixed picture yesterday. There's a bit more action in the bond markets. Yields are higher, 6 basis points in gilts at the front end and 4 basis points on the 2-year in Germany. That's it for markets today. Stay with us and Anna for the polls coming up.
York is as safe as it was when you were in the government?
It's not as safe as it was. Crime is clearly rising. I mean, it's not back to the dark old days of, pre-Giuliani in the early 90s. But we got to be careful because safety is the foundation of everything. And so I know the current mayor is committed to reducing crime, but we're going to have to be incredibly aggressive in making sure that crime does not increase.
Are you involved any longer in New York City matters, or you're advising New York City?
The mayor and governor actually asked me to co-chair a panel or a task force on reviving the commercial districts throughout the city. So I've been in the middle of that.
Welcome to the world of decentralized finance.
You can see the massive gains for the OG crypto coin.
The breakout we have all perhaps long awaited finally realized. We'll see if it sticks.
Bloomberg's covering all things crypto, the people.
There's no question this industry is composed of some bad actors and some good actors.
The transactions.
Volumes have surpassed $24 billion per day.
And the technology.
Stop talking about the technology, start demonstrating the utility.
Bloomberg Crypto, Tuesdays. And market movers. This is The Pulse with Francine Lacqua.
Good morning and welcome to The Pulse. I'm Anna Edwards in for Francine Lacqua in London. Here's what's coming up on today's programme. Back to back is back. Jerome Powell leaves the door open to consecutive rate hikes, with Christine Lagarde and Andrew Bailey also seeing more tightening as inflation remains sticky.
As noted in the FOMC's Summary of Economic Projections, a strong majority of committee participants expect that it will be appropriate to raise interest rates 2 or more times by the end of this year.
No stress. Wall Street's top banks all passed the Fed's annual resiliency tests, clearing a key hurdle for returning billions of dollars to shareholders. We will watch their stocks in pre-market trading. Also ahead, our weekly special focus on the biggest challenges facing Britain. This morning, we look at the UK's water crisis and a damning report on the country's climate goals. Good morning, everybody. 9:01 here in London. First, let's get a check on the markets then. This is the picture across European equity markets right now. Well, we're flat. Stock 600 not moving anywhere in a hurry. We have a bit of divergence around the various sectors, but essentially flat. Some of those companies reporting in the retail space moving a little higher this morning, but broadly flat. S&P futures also flat. NASDAQ futures had that Micron news to digest overnight, but NASDAQ futures flats are positive, up almost 0.1%. The euro also pretty flat today, 109.19. Christine Lagarde said yesterday that there's still more to do in terms of the hiking. July, we've got that message from Sintra, seems to be a fait accompli, we heard from policymakers, but none of those on the ECB Governing Council want to be drawn on what happens in September. The German two-year yield, really interesting to see that ticking higher this morning. That's on the back of the Spanish CPI print, which came in just a shade above expectations, even though it's sort of a victory in terms of the inflation fight in Europe. It's now down below 2% at 1.6%. But we are getting, in the German context, some numbers coming through from various regions which are stepping up. We've stepped up in North Rhine-Westphalia. We have stepped back up in Hesse. And the number for Bavaria coming through, that also a step up. And the number for Brandenburg, also a little bit of a step up. So some of those numbers just hitting the Bloomberg terminal, reasserting this message that perhaps we're not quite done with the fight against inflation in Germany and then the broader Eurozone. Let's have a look at the European equity market map then to pull out any areas of divergence. There's quite a bit of grey on that screen today. Certainly Germany is in grey, the Netherlands in grey. We don't see big moves essentially on these European equity markets today. We're down 0.2% on the stock 600. The CAC 40 up 0.1%, that getting the best of the gains of the major markets. The FTSE MIB though actually in Italy up by 0.5%. Let's return to some of the macro major themes this morning. The Federal Reserve Chair Jerome Powell said at least 2 interest rate increases are likely necessary this year to bring the inflation rate down to the US Central Bank's 2% target. Powell and other central bankers have been speaking at the ECB forum in Sintra.
We still have ground to cover.
Although policy is restrictive, it may not be restrictive enough, and it has not been restrictive for long enough.
We are data dependent. We will decide on a meeting-by-meeting basis.
We will be evidence-driven, so we will wait for the next set of evidence for our next meeting.
Underlying inflation is still a bit lower than 2%. That's why we are keeping policy unchanged at the moment.
If our baseline stands, then we also know that we will very likely hike again in July.
We're going to move the decisions a little bit, make them with a little bit more time in between them.
We will do what is necessary.
I wouldn't take, moving at consecutive meetings off the table at all.
Central bank governors on the battle against inflation there. Joining us now, UBS Chief Strategist Banu Baweja with us this morning to talk about these markets. Very good to see you, Banu. Thank you for joining us here on The Pulse. Let me ask you about what your base case is then for Fed tightening, because that seems to be one of the major factors driving markets, or it had been, certainly, in recent weeks, maybe not always these days. What are you assuming then? Are you assuming we do get back-to-back rate rises? What's your expectation?
The base case is that we don't, right? Base case is that we see one rate hike from the Fed, and then the Fed stands pat. Towards the end of the year, there may even be a cut, and next year they cut more than what's priced in, right? So we have to understand where the Fed is coming from. Last year, they made the mistake of saying inflation is temporary, or, in 2021, as well, they said inflation is temporary. Inflation may be temporary, but it wasn't 3-month temporary, probably 3-year temporary. And I think they're trying to gain back credibility, saying, all central banks are trying to gain back credibility, saying that we are going to hike till we kill this beast. Any central bank, when they're going to make a decision, they try to understand what is the least worst outcome. Right? The least worst outcome right now is not that they put it into a recession. The least worst outcome is that they, in fact, go hiking right now. What they don't want to see is that economy starts to reaccelerate and you begin to see inflation reaccelerate. That's why they're sounding as hawkish as they are. But here's the truth. Inflation is already declining, right? At headline level, it is declining. In the US, which is different from Europe, and we'll speak about that in a second, core inflation is also declining. So from the next print onwards, which is the June print, which is going to be released in July, we're expecting a whole string of about 0.2. So inflation's coming off hard. We think 1, but if the labor market holds up as well as it has, it should not, but if it holds up as well as it has, then it's probably 2.
Okay, that's interesting. So we'll get to the Europe conversation in just a moment, but just to push you a bit more on the Fed, or get a bit more detail from you, you say that you expect more cuts than are priced in. Was that in the second half of the year, sorry, or next year?
That's next year.
That's next year. So, I mean, if we're going to get cuts, not just a pause from the Fed,
yes.
That's certainly, I mean, it's not what the Fed is signaling it's going to do, is
Absolutely.
it? Does that assume quite a negative outturn then for the US economy?
So the Fed does not, so there are 2 issues on which we disagree with the Fed in their SEP forecast. First, we think that inflation is going to drop straight away now. So, from June onwards, we get 0.2, so the Fed starts accumulating forecast error. That's point 1. Point 2 is that we do expect a recession later this year, and the Fed does not, right? So we're thinking Q4, Q1 next year, we're going to get a recession, a mild recession, but a recession nonetheless that takes the unemployment rate to about 5% and slightly higher than that. And that's why we're expecting rate cuts. The market has, remember, the 2-year rate has already moved up. At one point post-SVB, the market was making the opposite mistake, where rates had gone down far too much, and it was pricing the Fed far too dovishly. I think the market is now pricing in Fed for 2023 appropriately, but for 2024, the market is pricing the Fed too hawkishly.
So if you're looking for a mild recession, what does investment strategy look like around that kind of scenario?
I think people don't respect mild recessions as much as they should, because they must a mild recession. Why should I get out of bed? I'm just going to buy the dip all the time. But a mild recession, which is a modest decline in real GDP, does not necessarily mean a modest decline in prices, right? In prices in the market, that is, right? Because you're assuming 2 things, that a mild recession is going to lead to no decline in prices because A, margins are at equilibrium, and B, PE's valuations are at equilibrium, and they're not. Margins are well above equilibrium, and PE is well above equilibrium. Right. So you can see a modest decline in real GDP lead to a pretty significant decline in prices in the market. So I think we are cautious on the market. While I do concede that it'll take some time for the earnings drawdown, which is going to be the real reason why market goes down. It's going to take some time for that to show up. I think that's going to be late Q3, Q4. But today, where vol is, where correlation is, where skew is, all of these are telling you that this is not a worried market. So central bankers are worried about recession. The narrative in investors' minds is worried about recession. The market price make no mistake, is not pricing in recession.
Okay, you see it's sort of, there's a vulnerability in the sort of expensiveness of things then. But what about the European story then? You say in your notes, Banny, ahead of our conversation, the ECB front end is mispriced relative to the Bank of England, I think. What's the story for you then that leads you to that conclusion?
I think core inflation in Europe is fundamentally different from core inflation in the US, in that real wages have been so negative for so long that I think people will try, workers will try in Europe to try and raise nominal wages for some time. So the basic difference is that as wages are coming down in the US, they may not come down in Europe at quite the same pace. So there may be a little more wage price memory in Europe than there is in the US. This is a less flexible labor market anyway, right? So you can possibly see headline inflation come off hard. Energy, food in particular, food has not yet come down and is likely to come down, but core inflation can remain high. So I think Schnabel is really on the ball on this, and she has been saying that we need to bring core inflation lower and we need to bring inflation expectations lower. So I suspect that ECB is mispriced relative not just to the Bank of England, but also relative to the Fed.
So does that open the door to the ECB continuing hiking, September and beyond then?
Potentially, yes. So we think we think we will see a hike in September, but there is a possibility that even beyond that, when the Fed is standing pat, that the ECB does hike. So it's not a given that if the Fed stands back, that everyone else does. There are differences in central banks, perhaps not as stark as between the Bank of Japan and the Federal Reserve, but nonetheless differences between central banks.
And that pulls up the euro, it creates headaches for exporters?
Yes, I think it can take it to 113 to 115. But remember, right now, Eurozone growth is abysmal right now, right? So you will see some lift for the euro as the front end goes up, but I think that will stall at between 113 to 115 this year.
What do credit spreads look like to you, Banu? If we're looking at a mild recession, sorry, not a wild one, but a mild recession, what does that do to credit spreads?
You know, if you look at US high yield credit spreads, they are priced not for a recession. You know, our day job is to look at economic data and say what financial markets we do. But if you reverse that and look at what financial markets are saying about economic data, you will see that US high yield spreads are actually pricing in not even close to a recession. They're pricing in well above trend growth, right? So US high yield spreads, we think, are phenomenally tight at these levels, extremely tight and extremely rich. So we think there'll be a decompression, and we see wides of US high yield spreads over the next 3 to 4 months of about 625 to 650 basis points. Right now, just to put this in perspective, we're at 410, right? So we see more than a 200 basis points widening in high yield spreads, and that'll matter for equities. It'll matter for valuations as well.
Banu, thank you so much. Really nice to see you. Thanks for joining us. UBS Chief Strategist Banu Baweja with us this morning on The Pulse. Let's have a look at where we are on a pre-market moving story over in the US. Micron, the chip maker, up in pre-market. You can see the pre-market move there up by just over 3%, 3.06. Maybe some upside then created for some others in the sector. We've got AMD, Nvidia, Intel on the board, all showing some modest move higher. Micron delivering a strong forecast in a sign that the glut is easing. That seems to be the pitch coming through from this particular business, calling the sales trough, suggesting things get better from here, and that certainly is pushing that share price a little higher in pre-market. Let's get to some of the other corporate stories that we are covering for you today. Bloomberg has learned that a Siemens Energy wind turbine defect could cost upwards of 1 billion euros. Executives at the renewable firm are concerned that the issue, a turbine base that has been found to twist and damage parts, could exceed their cost estimates. That could determine the viability of a business at the core of Europe's long-term climate goals. Sticking with utilities, and Thames Water bonds tumbled in yesterday's session after reports that Britain's biggest water company is in talks with officials over contingency plans, which could include a temporary nationalisation. The Thames Water debt crisis is a new problem to add to the issues facing the UK government, and we will talk more about the problems at Thames Water in our weekly UK show. That's coming up at 1:30 this hour, so in around 20 minutes' time, 9:30 London time. EU leaders are in Brussels today with China, Russia and the war in Ukraine among the items topping their summit agenda. We're there live on the ground. Next, we'll bring you an update. This is The Pulse. adults are facing some tough challenges. Higher living and education costs and wages that aren't keeping up with inflation are making it harder for them to support themselves. And they're relying more on the bank of mom and dad. A new bank rate report shows nearly 70% of parents with kids 18 and older are putting their own finances in danger to help them. About half are dipping into their emergency savings or delaying paying off debt, while 43% drain their retirement funds. So where do you draw the line? There seems to be a generational gap, as older parents can't understand why being self-sufficient now is a lot harder than it was for them. Gen Z seems to think on average that 22 is a benchmark for covering the expenses, while baby boomers say their adult children should pay their own way closer to age 20. Either way, it's a family decision. Bankrate suggests having a conversation with your kids and setting a specific dollar amount or time frame for footing the bill.
Our studios in New York and San Francisco. Our expert hosts have the data and analysis about the companies you know and the startups to watch. Plus, the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West. Only on Bloomberg Television, your global business authority.
The conversations that matter and the insights you need. This is The Pulse. I'm Anna Edwards, in for Francine Lacroix here in London. European leaders are gathering in Brussels today after the dramatic events in Russia last weekend and following the ECB Central Bank Forum in Portugal. Bloomberg's Europe correspondent Maria Tadeo joins us now on the ground with the assembled world media attending this leaders meeting then. Maria, the ECB Forum wrapped up yesterday. How will the hawkish messages be received? Because we heard quite a lot of hawkishness about the fait accompli of a July rate hike and some speculation around September.
Yes, Anna, and persistent for as long as inflation stays persistent. But Anna, you know, there's this almost understanding, and you know this very well, between the politicians and the central bank, that the politicians do not comment on the ECB and the European Central Bank stays out of politics, and that has usually been the case. But I think now we're seeing some discontent to some extent when you hear the Italian Prime Minister, Giorgia Meloni, this week say when you continue to increase rates this way, well, the disease could actually be at this point a problem, but the curse could be, or the way to cure it could be even worse. I think what you're also seeing now is a real debate behind the scenes here as to whether the European Central Bank will be able to orchestrate this soft landing, this idea that you tame inflation, but you maintain some level of growth. And if we do see a downturn, well, for a lot of politicians, that is something they have to explain to their voters, and then it becomes a political story. So yes, there is a separation between the two of them, but I would argue there is now a growing debate, especially when you look at some of the data that we've seen recently about this soft landing. Can they do it? Can they get it done? Also, when you look at the data coming out of Spain today, yes, headline inflation below 2%, but funnily enough, in that country, and there's an election coming up, the economy is not really playing a major role in the election campaign.
Yeah, that's a really interesting dynamic to watch. Also on the agenda, or at least to some degree eclipsing all the other things on the agenda, I suppose, Russia's war in Ukraine then, Maria. That and the events in Russia itself clearly will be discussed.
Yes, and Anna, on that note, we should make clear that this summit was already in the agenda. Like, it's not a response to the events that we saw play out in Russia, but of course, European leaders are expected to debrief the situation. We see once again how the war in Ukraine eclipses a lot of the politics here in this region, that instability that has kicked off as a result of the war. And by the way, we're also expecting now that the head of NATO, the Secretary General, Mr. Stoltenberg, will join European leaders for a working lunch today. And on that note, Anna, Mr. Stoltenberg, the whispers now in Brussels suggest that he will stay on the job for another year. Remember, he was supposed to leave in 2022. Then, of course, a war broke out. He was extended for a year. And now it looks like he's going to stay for another year, too.
Okay, Maria, thanks very much. Bloomberg's Maria Tadeo, well placed, as we can very clearly see at that EU Leaders Summit. Thank you very much, Maria, for bringing us the things we need to know about that. Now, sticking with Russia, with heavy sanctions and tightening economic conditions, Moscow has been pivoting its gas sales away from delivering gas to the West. But where does all the banned Russia gas go to? Here with us, Bloomberg Senior Executive Editor for Energy and Commodities, Will Kennedy. Good to have you with us again, Will. Let me ask you then about what's happening with Russian gas. Let's stick to gas for the moment before broadening the conversation. Essentially, the pipelines, the majority of the pipelines point to Western economies, and that's not where the gas is needed to go these days.
Absolutely. Russia's gas industry was built up from the 1960s onwards, supplying Europe through these long pipelines that run from Siberia all the way into Germany and other places in Western Europe. And those pipelines aren't needed anymore because Europe has decided to stop buying that gas. It still buys some Russian LNG, but it's not buying any Russian pipeline gas. So the difficulty Russia has is to find new markets for that gas, and it's using more in some places domestically. It would love to be able to sell more to China, but there's only one pipeline and it's not connected to the broader network. It's talking about a second pipeline, but the Chinese are lukewarm. So what we have is, in contrast to oil, a market drop in Russian gas production. It's running at 13% less this year than the previous year, and that's really biting into government revenues.
Okay, so less money from gas sales then to wage war in Ukraine. If the gas it needs moving, you need a pipeline or you need an LNG infrastructure, and if you don't have that, it's costly to create, as we've seen in parts of Europe. On the oil side of things, though, if the market moves and you need to send it somewhere else, it's a little bit easier to move it where it needs to go.
That's exactly right. With oil, you need to get it onto a tanker, and then you're pretty free to sail it to wherever you'd like. And obviously, Russia used to sell a lot of oil to Europe, and Europe has stopped buying that Russian oil. But what Russia's been able to do, partly with the blessing of the price cap regime to limit prices while keeping the oil flowing, it's been able to sell that oil to India and Russia. And India, for example, is buying huge amounts of Russian gas, oil, where it didn't before. And you've seen a real reordering in the global oil market in a way with a flexibility that's not possible in the gas market.
Okay, Will, thanks very much. Thanks for the insights. Bloomberg's Will Kennedy with a focus on the gas and oil markets and where the oil and gas has been going from Russia. Coming up on the programme, we hear from the Greek central bank governor on the country's fight against inflation. That's next. This is The Pulse.
On the product may read "Made in the USA," but the sign on the CEO's door often says "Made in India." Alphabet's Sundar Pichai, Microsoft's Satya Nadella, IBM's Arvind Krishna, Micron Technology's Sanjay Mehrotra, and that's just the start. Add in the chief executives of Adobe, Deloitte, Gap, VMware, and that doesn't count Indians running companies all over the world. Why have so many Indians risen to the top? Vinod Khosla points to India's incredibly competitive education system. If you can survive the pressure it takes to get into one of the Indian institutes of technology, it gives you confidence to handle American universities and later the business world. Meanwhile, the belief in India's ability to produce so many tech wizards is reinforced every year. Indians make up about 3/4 of the immigrants receiving coveted H-1B visas for the U.S., and it's a safe bet that some of them will eventually find their way to the C-suite.
Business Week Radio. Live weekday afternoons at 3 p.m. Eastern.
We got a little bit of talking.
But are you guys ready?
Harnessing the power of Bloomberg Business Week, Carol Masser and Tim Stanovic bring you the latest news from the worlds of business, technology, politics, and more.
How does the Fed play into this and what the Fed does potentially?
This is so exhausting and this is so all-encompassing.
Listen on Bloomberg Radio and streaming on YouTube and Bloomberg Originals. In a multi-trillion-dollar industry, there's a lot of ground to cover.
We indeed have a rally.
We're talking a lot of dividends. We're talking income.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg.
If the baseline develops as we think, then perhaps, yes, in July we're going to have a hike. There are good news. Inflation is falling. Past decisions will have an impact from now on as well. We also tighten our balance sheet. So all in all, I think we are following the path we have planned.
That's the Greek Central Bank Governor Yanis Stournaderas speaking there, talking to Bloomberg about interest rates and expressing confidence that his country will regain investment grade status soon. Of course, the recent election critical perhaps to that. Let me just dive into some data we've had out of Germany. Slowly through the morning, bit by bit, we've been building up a picture of German inflation, and we get the full German number later on, early afternoon European time. And we're just getting another region to add to the mix. So Baden-Württemberg is the latest one, ticking up from 6.6 to 6.9. And so we've seen all the regions, Brandenburg, Bavaria, Hesse, North Rhine-Westphalia, they've all ticked up from the prior month. So the month of June turning out to be a period where we get a step up in inflation in the German story, even though we've seen quite a step down in the Spanish story. We got those numbers earlier on this morning. That's having an impact, I should say, on bond markets. Let's take a look at the stories that have caught our attention this morning. The alleged Chinese spy balloon that floated over the continental US earlier this year was reportedly equipped with American-made surveillance gear. That is according to the Wall Street Journal. The paper says an analysis by US agencies of debris recovered after the balloon was shot down found that the craft had been filled with commercially available American equipment and more specialized Chinese sensors. The creator of ChatGPT, OpenAI, is being sued in a class action lawsuit. The suit alleges the AI bot breaks the law by secretly scraping private information from the internet without consent on a, quote, unprecedented scale. An OpenAI spokesperson didn't immediately respond for comment from Bloomberg. Back to the markets then. I mentioned some of the moves in the German bond market that we're seeing as a result of the data we're building up on the German inflation story and the Spanish data, perhaps adding to that a little bit, even though it came down versus the prior month. It was a little higher than expected, but that's the picture on the German bond market. You can see it at the bottom there. Stocks going nowhere in a hurry, it seems, in terms of the European story and US futures. Euro-dollar flat. Keeping a focus on the UK next. Coming up, a deep dive into the UK's net zero climate commitments. This is Bloomberg.
Okay, so you're moving in on me, quick, distracting me with your fancy hands. I'm going to deal with your night because it's really bothering me.
Ah, my nights.
Yeah. He's a troublemaker.
Yeah.
What did you get up to this weekend?
You know, just robot stuff. A lot of chess. I was practicing for you. I know you're pretty good. Ooh, I don't like that. I will take this. Put it over here.
Not cool. Not cool. All right. I will concede. I can see. You've got me beat.
Very good game. Well played.
Thank you, sir. Thank you.
From the world of politics to the world of business. Every weekday at 5 p.m. Eastern Time, hosts Anne-Marie Hordern and Joe Matthew alongside Kaylee Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power, every weekday at 5 p.m. Eastern Time, only on Bloomberg, your global business authority.
Welcome back to Bloomberg Daybreak Europe.
Good morning, good morning. This is Bloomberg Surveillance. Welcome to Bloomberg Markets, trying to open.
This is Bloomberg Technology.
And welcome to Balance of Power. This is Bloomberg.
Good morning and welcome to Bloomberg UK, a special focus on the biggest challenges facing the British government, economy, financial services and markets. I'm Anna Edwards in for Francine Lacroix here in London. Today our focus is on the UK's climate goals. The country's ambitions to reach net zero emissions by 2050 have been called into question by the UK's Climate Change Committee. Britain has committed to cut greenhouse gas emissions by at least 68% by 2030 compared to 1990 levels. However, the independent advisor to the government says delivery delay risks are dragging the UK away from that commitment. They say key opportunities to push a faster pace of progress have been missed. Lord Deben, the chairman of the CCC, gave his criticism in the report, saying, quote, government has been too slow to embrace cleaner, cheaper alternatives and too keen to support new production of coal, oil and gas. I'm very pleased to say that we're joined now by the CEO of the UK's Climate Change Committee, Chris Stark, on set with me here in London. Chris, nice to have you with us. Thank you for joining us. So why this less confidence you find yourself with today versus a year ago in terms of the UK's ability to meet its climate goals?
Well, it's been a really important year for lots of reasons, but these incredibly important global events taking place, driven, of course, by what's happening in Ukraine right now. But also here domestically, here in the UK government was taken to the courts. The High Court in London last July found that the strategy that the UK had for net zero needed to be more transparent. So what we've also looked at this year is an unprecedented amount of detail from the government on the programme that they have for net zero. You may expect that that would lead us to be more confident in our assessment of the future targets that the country has. Sadly, the opposite is true. So what we've learned is with this extra detail from the government that we have less confidence about the future targets that the country has in place. And the reason for that is the lack of commitments in some key areas from UK ministers.
Okay. So which of the commitments are missing? Because as you say, you know, a lot of detail, thousands of pages of extra detail for you guys to sift through, 3,000 pages of new detail. And the criticism for a long time had been, great, the UK is kind of leading the way with these really high goals, but then actually delivering them, you know, how are you going to do that? 3,000 pages of detail should have joined the dots. It doesn't. So what's left to do?
Well, there's so much left to do. And one of the reasons for being so critical yesterday in the report that we published is that there's not long left until the 2030 goal. So it's only 18 months since we had the Glasgow summit, COP26.
And we're 7 years from Paris and 7 years to 2030.
Exactly, yeah. So we did some nice work looking at just, you know, the pace of change that's necessary and the pace of progress and how that needs to change over the coming years. If you look back 7, 8 years, you'll see that if we take out the key area where the UK has been successful, that's the power sector, we've only been reducing emissions by about 1% per year over the recent period. If you roll forward to 2030, to the goals that we have to hit, you need to quadruple the pace of progress in a host of sectors, the transport sector, industry sectors, farming and agriculture, buildings, which is one of the really big challenges for the UK. We don't see a policy programme that has that kind of quadrupling effect over the next 7 or 8 years. So,
yeah. I mean, what about where we get our energy from, though? Because government ministers will tell you about the step up in wind energy, and we've seen, you know, some nice achievements on that front. A big expansion, big rollout of new wind infrastructure, and days where we get a lot more wind, a lot more power from wind than we get from various other sources. So it's just too slow. A lot's been done, but not enough.
Yeah, we do have a plan in this country to get to a fully decarbonised power system by the middle of the 2030s. And actually, that's the one area where we have seen progress. We've continued to see progress over the last 12 months, but it's too slow. One of the key issues that we flag in the report is that the planning regime is now getting in the way of some of the key infrastructure that we need for that renewables future. And that's kind of part one, really, of the whole plan for the country. Decarbonise the source of energy, then electrify most of the economy, electrify your transport system, electrify how you heat buildings. And if we're slow on cleaning up the supply of electricity, then we'll be slow on all the other stuff too. So again, that's a key issue for the government. They need to unblock the planning system.
So if we electrify where we get our power from and we electrify the economy, so everything is coming from electricity essentially rather than gas, is that enough then? Is that enough, Chris? Does that satisfy the goals?
It doesn't. So there's a little bit more to do. So the target for the country, the target for the world actually is net zero, and it's the net bit that really matters. So for those sectors that presently use fossil fuels, we think we have a really good sense of what you need to do to decarbonise and get to actual zero emissions. That's mostly about electrifying those sectors, so electrifying heat, electrifying transport, electrifying industry. But that isn't enough. That still leaves you with a rump of emissions from farming in particular, and also probably from flying. So although there are lots of plans to introduce new technology for flying without emissions, they are probably for the next half of the century. So that means you've got to do something on the other side of the ledger, and that's mostly about what you do in the natural world. So preparing land that is presently used for farming so that we are able to store more carbon in it. Also potentially growing things like energy crops, then using those energy crops with carbon capture to actually take carbon out of the atmosphere permanently. That's the kind of stuff the UK needs to pioneer, and then we've got something to offer to the rest of the world.
If you grow energy crops, though, are you not growing food? Is that one of the issues?
That's the key challenge. So you've got, particularly in the UK, this is not like the US. We don't have large prairie states where you've got lots of options. We are very land constrained in the UK, which is partly why it's such a good place to look at some of these issues. So if we choose to grow an energy crop, then we have to decide not to do something else on that piece of land. So squeezing all the things that we need onto the constrained land that we have in this country is one of the key net zero challenges.
Yeah. What about efforts to persuade people to use less energy? Because even if you electrify the economy, as you suggest, still work to do. So then don't focus on that, focus on demand for energy. But that's not something that politicians want to step into here in the UK. What's your assessment there, or advice?
Well, that's a very good take on what we've said, actually. So one of the key components of any strategy for cutting emissions in any economy is that you need to do something on the demand side. So, constraining all those high carbon products and services that we use today. Now, some of that's happening already. If you look at things like diet, for example, that's a really critical component of the transition ahead, and we are eating less meat. But what we've seen from the government here in the UK is they've been far, far less willing to talk about demand side measures. So far less willing to say that we should, for example, travel less on roads, change diets, but also things like flying less. Those kind of things really do matter in the long run. They won't take us all the way to net zero. We still have a set of things to do on the supply side, but they do help.
Do you think governments that want to win elections can push those messages?
I think there is a ready market out there in the populace. So you can see all of the polling that's been done by the Office for National Statistics, the official statistics body that we have in the UK, shows very, very clearly people have a high degree of concern now about climate change and are willing to make changes there. What's missing is some information for people living in this country about what they can do. I think the other part of it, and this is another key message in the report, we need to provide the incentives for people to make the easy choices. We can't have a country full of climate activists. It won't work that way. So what we need is for people to be led to the choices that happen to be climate positive. The key issue is actually giving a stronger incentive for people in this country to use electricity versus fossil fuels. So we're generating more and more of this clean electricity, and we will continue to do that into the future, but we need that electricity to be cheap for the consumer versus gas.
Okay, so that's sort of something around the way the market works to make that the outcome. What about the housing stock in the UK? Very aged housing stock relative to other places. I spoke to the CEO of NatWest yesterday, and she's still pretty confident. She works on that task force that advises government. She's on the GFANS committee, but she's quite positive about what can be done with the housing stock, but there's still a lot of work to do there.
There's a heck of a lot to do there. So we've got, housing stock, about 28 million houses in this country, 30 million buildings that all need to be decarbonised. Now, the biggest challenge there is to bring those buildings a low-carbon source of heat. Potentially, as the climate warms, we'll also need to bring them cooling as well. So we really need a renovation strategy for the whole of the country. This is probably the biggest challenge for the UK.
And who pays for that? With all of the other cost of living challenges is a real issue.
It is, and it's a huge capex project for the whole country. What we can say, though, is that making the investment in the built environment does really reveal savings later. So in particular, if you can make buildings more energy efficient, that's a really sensible thing to do. In the long run, we're using less energy, and it makes for a cheaper economy, essentially. So that challenge overall is one that can be financed rather than funded, but is absolutely the case. We've got large parts of the economy, particularly during a cost of living crisis, that is simply not going to be in the market for shopping for a heat pump when they can't pay their gas bill.
Yeah, and finding someone to fit the heat pump also.
Huge challenge there too. So building the supply chains to install this stuff is a really critical challenge for net zero.
Chris, thank you so much. Thank you for joining us. Chris Stark, the CEO of the UK's Climate Change Committee, finding the government wanting in terms of its preparedness and the detail around its commitments on climate. Coming up on the programme, we'll continue this conversation. We'll speak to the senior advisor at Green Finance Institute about the role of finance in achieving net zero. We'll pick up where we left off. This is The Pulse.
Is as safe as it was when you were in the government?
It's not as safe as it was. Crime is clearly rising. I mean, it's not back to the dark old days of, pre-Giuliani in the early 90s. But we got to be careful because safety is the foundation of everything. And so I know the current mayor is committed to reducing crime. But we're going to have to be incredibly aggressive in making sure that crime does not increase.
Are you involved any longer in New York City matters, or your advisor?
Yeah, the mayor and governor actually asked me to co-chair a panel or a task force on reviving the commercial districts throughout the city. So I've been in the middle of that.
Covering the biggest challenges facing the UK government, economy, financial services and markets.
Tax cuts should not be the priority. It's about a credible plan for growth over the next 2-3 years.
In this post-Brexit world, how do you see actually servicing your clients?
It was disruptive, and it's going to have implications to how capital raising works.
Now we're having the perfect storm in the UK.
Watch Francine Lacqua Thursdays at 9:30 a.m. only on Bloomberg, your global business authority. In a multi-trillion-dollar industry, there's a lot of ground to cover.
We indeed have a rally.
We're talking a lot of dividends. We're talking income.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg.
This is Bloomberg.
We're falling behind globally. It's complicated, but it's imperative. I mean, I don't talk about it about climate transition. I talk about it as climate emergency. And this isn't going to happen unless the public and private sector come together in order to drive this change. I think there is really good momentum that we've driven. GFANZ, of which I'm a founding member, huge amounts of private sector money, huge mobilization, real change and real drive. But it is at the practical level. How do you get those public and private sector partnerships?
That was the NatWest Group CEO, Alison Rose, speaking to me yesterday at Bloomberg's Sustainable Business Summit in London. She was talking about the importance of private-public sector partnerships in achieving climate goals. Let's talk about that now. Let's get more on the role of finance in driving the change. I'm joined by Kelly Clark, Senior Advisor at the Green Finance Institute. Kelly, nice to have you with us. So Alison put a lot of focus, the CEO of NatWest, on this private and public. She talked a lot about SMEs as well and their opportunity in greening the UK economy. Is that the solution, the private meets public combination?
I think it's critical. It's absolutely critical. We know that there is enough capital in the system to make this transition, but what we need now is to move into public-private partnerships where the government is able to help de-risk the capital flows. And that can be done through guarantees, aggregation, syndication, strong policy signals, but it's absolutely critical. And, you know, there's even a role for philanthropy in this. It's all hands on deck and really getting the capital mobilized to all of these projects.
Okay, so that's how you get the capital in the right place for the green agenda. I was just talking to Chris Stark at the CCC, the Climate Change Committee in the UK. We talked about homes, because this is a big issue in the UK about greening the housing stock. And he was saying that there should be room to finance, not fund, that kind of investment in the housing infrastructure. How do you see this being funded then, Kelly? How do the private and public come together to get this done?
Excellent. Well, I think this is definitely an area where the Green Finance Institute has spent a lot of time thinking and innovating. One of the finance mechanisms that can be applied to this is property-backed loans, where you actually look at the house as an asset and you then lend on the ability of that asset to be decarbonized or energy efficient. I think that's critical. You can tie it into long-term lending like a mortgage, and the market's heating up to be able to provide these kinds of products to retail investors and homeowners.
Is that sort of doubling down on the efficiency ratings that homes have had in the past?
Exactly. And it's as Chris said, it's a huge CapEx opportunity and need, but also, I mean, it's in some ways a real low-hanging fruit. I mean, 28 million homes and 30 million buildings, it's an enormous part of our emissions.
What about the agriculture sector? Chris was referencing that and what's happening there. Alison Rose at NatWest was also referencing that sector because it has some impact on the balance sheet, and so it's a concern for her. What are the steps that need to be taken in that particular sector?
Oh, it's an absolutely huge opportunity. As we all know, the TNFD is starting to come up with the matrix and the indicators for how we preserve and price nature. We know that we need to rehabilitate wildland. We need to plant more trees. We need to figure out ways that nature-based solutions can be injected into the balance sheets and the goals of all companies. We know that the majority of publicly traded companies and SMEs rely on nature to continue to thrive.
So this is sort of rise of the nature market, the Task Force on Nature-Related Financial Disclosures, TNFD, as you reference. What do you say about the role of pension funds here in the oil and gas sector? We heard the CCC's conclusions that the government is focused too much on allowing more of the old stuff, of the fossil fuels, to be exploited. I mean, the sector, some in the sector are pushing away from those companies that don't have, for example, Paris-compliant transition programs. Others are saying they won't go for oil and gas at all. But some are saying, look, you've got to stay engaged, because if you're not at the top table as a shareholder, you don't get to influence the policy. Where do you stand?
Okay, well, it's a very good question, and it's one that there's a lot of debate around. As you would have seen last week, the Church of England has finally divested from Shell after years and years of engaging. It was big news. I think that what we need to focus on is the oil and gas companies that are part of pension portfolios need to be really accelerating their transition plans, sharing them with their shareholders so they can understand where transition is happening, and really looking at assets that they currently have to kickstart the carbon removal and the carbon capture and storage market. Not every oil and gas company will be able to transition. And what we need is to stop new infrastructure, new drilling, and really make what exists fast track towards transition and decarbonization.
In terms of the private sector in its role here, are you seeing evidence of companies turning their backs a little or turning away from their previous commitments around climate? That seems to be the conclusion that some have taken away from some recent news flow, that maybe companies are finding it harder than they thought to get to those net, or to really plan for net zero. And so they're backing away from those commitments. Do you see that?
I think, again, it's a tough question. I think every company that wants to be a leader in its sector and wants to be a relevant company in the future knows that it needs a transition plan, and it needs to be able to count on its natural resources like water, clean air, soil. So companies haven't done this before. It is hard work. I think one of the things that we can do in the private sector, and certainly at the Green Finance Institute, is help create really compelling pre-competitive collaboration where companies can learn from each other about what's working, can create a race to the top, and also to de-risk each other, because nobody wants to lose their competitive advantage, but these shifts really require quite a lot of commitment.
Okay, Kelly, thank you very much. Thank you for joining us. Kelly Clark, Senior Advisor to GFI, the Green Finance Institute. Coming up on the programme, we take a deep dive into the UK's climate goals with a panel of Bloomberg contributors. Will the nation meet its targets? We'll discuss that next. We will also get the latest on the water sector. This is Bloomberg UK.
Japan's critical role in the global economy is changing as the world recalibrates. After decades of stagnation, Japan's leaders are forging a more innovative and sustainable path forward to revitalize the nation. Corporate giants, policymakers, and pioneers tell us how they're doing just that. Every week on Japan Ahead, right here on Bloomberg Television.
Welcome to the world of decentralized finance.
You can see the massive gains for the OG crypto coin.
The breakout we have all perhaps long awaited finally realized. We'll see if it sticks.
Bloomberg's covering all things crypto, the people.
There's no question this industry is composed of some bad actors and some good actors.
The transactions.
Volumes have surpassed $24 billion per day.
And the technology.
Stop talking about the technology, start demonstrating the utility.
Bloomberg Crypto, Tuesdays. Markets count down in Europe from the financial centers of the world. Bloomberg Markets European Close with Guy Johnson in London and Alex Steele in New York. Real-time numbers, real-time analysis. Weekdays. Our studios in New York and San Francisco. Our expert hosts of the data and analysis about the companies you know and the startups to watch. Plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West. Only on Bloomberg Television, your global business authority. Business Week Radio, live weekday afternoons at 3 p.m. Eastern.
We got a little bit of talking.
Come on, are you guys ready?
Harnessing the power of Bloomberg Business Week, Carol Masser and Tim Stanovic bring you the latest news from the worlds of business, technology, politics, and more.
How does the Fed play into this and what the Fed does potentially?
This is so exhausting and this is so all-encompassing.
Listen on Bloomberg Radio and streaming on YouTube and Bloomberg Originals. Of politics to the world of business. Every weekday at 5 p.m. Eastern Time, hosts Anne-Marie Hordern and Joe Matthew alongside Kaylee Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power, every weekday at 5 p.m. Eastern Time, only on Bloomberg, your global business authority.
Welcome back to Bloomberg UK. Let's continue our special focus on the UK's climate goals and the role that business can play. I'm going to be joined in just a moment by Bloomberg's executive editor, John Farrar. Also joined, though, by our reporter, Rachel Morrison, who covers power, gas, renewables, and the energy transition for Bloomberg. Perfect voices to have on the programme. Rachel, let's come to you first. So I was just speaking to the CCC, the Committee on Climate Change, and they've been very critical this week on the UK government's efforts, saying, you know, it's not moving fast enough. And specifically specifically around the transition to renewables. You know, the electrification of the economy, yes, it's happening, but it isn't going quickly enough. Is that what you hear from the industry?
Yes, I think what was interesting about the report is that it highlighted that what the government's relying on isn't happening quickly enough. So the technologies like carbon capture and storage, hydrogen, we know they're coming, but they're not coming fast enough to meet the goals, which are getting nearer and nearer. So that's part of the problem. And also some of what we need is still unquantified by the government. So that's interesting. It really highlights what's missing, and the goals just don't look like they're going to be met. Okay, and despite these 3,000 extra pages of detail from the government after a court challenge that was supposed to answer some of these questions for us. John, good morning to you. Meanwhile, as the UK tries to transition, and we're 7 years from Paris and 7 years to 2030, we've been hosting a sustainability event here at Bloomberg, and what's been interesting is some of the commentary we've got from companies, because companies want to tell you what they're doing around the green agenda. They like talking about that. It makes good PR. But what are you seeing beneath the surface about companies' commitments to net zero?
Well, I think what we're seeing now is 2 or 3 years ago, we saw this flurry of net zero commitments from companies right across the board. And I think what we're seeing now is like companies slowly realizing that just how hard this is going to be. I think, obviously, as Rachel was saying, like the technologies exist, whether it's batteries, whether it's carbon capture, whether it's hydrogen, but firstly, how do you deploy them? Because the logistics of this are very difficult, and how can you do that in a cost-effective way? It feels like we're possibly getting there on passenger cars, but what do you do about trucks? What do you do about heavy industry, etc.? So this is going to be really, really, really difficult, and I think that's what you're seeing.
And what do you do about Kit Kats is one question
that
comes
to mind. What do you do
mind.
about Kit Kats?
Because Nestlé has abandoned its pledge to make major brands, including Kit Kat and Perrier, carbon neutral, and our colleagues describing this as a sort of nascent corporate pushback.
Well, I think I think the Kit Kat case study is actually a very interesting one, because if you dig into it, a lot of Nestlé's pledges for Kit Kat and Perrier and what have you were based on this idea of carbon offsets. We will offset part of our emissions, against forests that we're planting or renewable facilities that we're financing. But these offsets, thanks to reporting from Bloomberg Green and other outlets, there's a lot of skepticism about just how effective these offsets really are. So I think with the Kit Kat example, what you're seeing is a great example of how companies are realizing this is actually much harder than they initially were hoping for.
So that's much harder for Nestlé, and they're facing up to that reality. Something that is also hard, it would seem, Rachel, is investing in infrastructure in UK water. And that's my attempt to tie us into another story that I know you've been covering over the last 24 hours, which is the ongoing saga at Thames Water, the CEO leaving, the debt dropping in price as a result of concerns about its viability and talk of whether the government takes it over. What's the very latest on that, on what kind of renationalisation we would see if that comes to pass?
At the moment, the government's really pushing it back to the company and trying to find a market solution. So the company's talking to its equity investors, trying to get more equity to prevent the nationalisation that we know the government's looking at. So that's really a sort of backstop, a last resort. And everybody says they hope it doesn't get there. But, it's interesting because it puts it back on the taxpayer at a time when people can't afford a lot of things.
It's not all doom and gloom, though, John, the last word?
But it's not all doom and gloom. I mean, I think, obviously countries like the UK and others are really struggling to sort of show credible roadmaps in terms of how to get to 2050. But if you look at the Inflation Reduction Act
over in the
United States, that is going to unleash a torrent of money into green technologies. Last week we had a scoop about how Ford was getting $9.2 billion to build some battery plants. And I think what you're also seeing from the Inflation Reduction Act is this sort of sense of global competition now. There is this sense that global industry is going to have to make this big leap. EU, China, watch them, because there's a lot more money coming through.
Thank you very much to our Bloomberg Executive Editor, John Fryer, and our gas, power and renewables reporter, Rachel Morrison, both of them bringing us their perspective. If you wonder where Francine is, she's over at the Future of Finance event in Zurich. She'll be back shortly. This is Bloomberg.
Venture capital, it's been volatile. From bank crisis anxiety to AI exuberance, Caroline Hyde and Ed Ludlow chat with the biggest names about the latest tech trends.
Is AI going to dominate the earnings narrative for this sector this week?
I think we're seeing opportunity and potential platform shift that we haven't seen in a long time.
If you're a company today and you're not embracing the changes that are taking place with AI, you're going to be behind.
How do you prove to the investor base that you haven't just tacked on AI to make yourself sexy?
It's very hard to differentiate if you're not experienced with AI.
The startup stories.
We think this is a watershed moment for technology.
Certain categories are more exciting than others. Right now, obviously, generative AI is a category that is very exciting to startup founders, customers, and venture capitalists as well.
So what we are seeing is a new area of opportunities for new founders to come and change the industries that matter.
And the real talk on realistic valuations.
Some of the best opportunities are sitting right in front of us.
How do you discern which ones are good on the marketplace right now?
I think founders have woken up to the reality that taking on more money at higher terms doesn't necessarily play to their benefit in the long run.
How do you actually invest?
Follow the VC money on Bloomberg Technology, the only daily business show dedicated to tech right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West, only on Bloomberg Television. Bloomberg UK, your source for news and analysis covering the biggest challenges facing the UK government, economy, financial services, and markets.
Tax cuts should not be the priority. It's about a credible plan for growth over the next 2-3 years.
In this post-Brexit world, how do you see actually servicing your clients?
It was disruptive, and it's going to have implications to how capital raising works.
Now we're having the perfect storm in the UK.
Watch Francine Lacqua Thursdays at 9:30 a.m. only on Bloomberg, your global business authority.
DOJ or other authorities
could face bigger challenges next.
It was going to keep rate World Cup. This is a 3.
As the economic picture does.
The BOK is getting ready to make a decision.
Adults are facing some tough challenges. Higher living and education costs and wages that aren't keeping up with inflation are making it harder for them to support themselves. And they're relying more on the bank of mom and dad. A new bank rate report shows nearly 70% of parents with kids 18 and older are putting their own finances in danger to help them. About half are dipping into their emergency savings or delaying paying off debt, while 43% drain their retirement funds. So where do you draw the line? There seems to be a generational gap, as older parents can't understand why being self-sufficient now is a lot harder than it was for them. Gen Z seems to think on average that 22 is a benchmark for covering the expenses, while baby boomers say their adult children should pay their own way closer to age 20. Either way, it's a family decision. Bankrate suggests having a conversation with your kids and setting a specific dollar amount or time frame for footing the bill.
This is Bloomberg Surveillance Early Edition with Danny Berger and Kriti Gupta.
It's 10 a.m. in London, 5 a.m. in New York, and 5 p.m. in Hong Kong. Our top stories today. Top central bankers beat the hawkish drum, saying they have a ways to go in reining in too high inflation. New CPI data from Spain and Germany add fuel to the debate. Wall Street's biggest banks all passed the Fed's annual stress test, clearing a key hurdle for returning billions of dollars to investors. And the chips are up. Micron delivers an upbeat sales forecast in a sign that an industry glut is easing. Welcome to Bloomberg Surveillance. It's the early edition. Good morning to everyone. I'm Danny Berger in London. Kriti Gupta is in New York. Kriti, I got to say these markets are hard to read. We got a whole lot of hawks yesterday in Sintra. Inflation's still high in Europe, but I kind of get the sense that quarter end is more important right now for markets than those facts.
Yeah, it does actually feel like rebalancing is afloat here, because if you look at the fundamental factors, the commentary coming out of Sintra, even the perhaps good news you got out of Micron overnight, should all point to a positive open, and yet we are seeing a little bit of that, but perhaps not the same momentum that we would expect. And there are NASDAQ futures up here higher by about 0.2%, because I would say out of the three benchmarks, the S&P 500, and of course the Russell as well, the NASDAQ is where you're seeing outperformance, but again, only by 0.2%. So again, nothing really to write home about. Let's see though if those gains accelerate or get prepared as we get closer and closer to those opening bells. The bond market gets interesting, though, Danny. As to your point, we talk a lot about what's going on in Sintra. The 2-year yield, 4.75. You're higher by 4 basis points already. So you are seeing a little bit of repricing. I think the comments coming out from Chairman Powell specifically about the idea of back-to-back hikes not being off the table is seen as not only hawkish, but perhaps probable, and that's something that is being priced into the market here. Again, 4 basis point move already, and it is only 5 a.m. in New York. What's interesting, though, is how that squares with the rest of the dynamic, because, of course, the ECB, the BOE, and, of course, the BOJ dealing with very different issues, as is the PBOC. And I think the highlight overnight that we got from the Asian session is simply that the yuan has had its strongest fixing yet again. 7.25 on the offshore yuan, the currency pair here, stronger for the dollar, say by about 0.2%. That being said, this is the third time that they have gone and kind of intervened in the currency by a larger margin than expected just this week. So the question here is, how does the Chinese economy really fare as we talk about these same pressures, inflation, recession, and of course, perhaps money pulling out of that region as well. NYMEX crude is always a great check for those questions. 69 handle down, well, excuse me, up about 0.4%. But again, how much of that is a geopolitical story as opposed to really some sort of indicator of whether or not recession is around the corner?
Well, Kriti, let me take you over to the European session. We're about 2 hours into the European cash equity trading day. Most of these indices are doing better, except for the FTSE 100. Mid-cap UK stocks doing even worse today. There's some concerns there about not national, but utility companies. Will they be nationalized? We're going to talk about that later in the program. We've also had a whole lot of data out of Europe. We just recently got regional figures from Saxony, that state in Germany. Again, inflation picking up in the past month, 6.2%. It was around 5.7 the month prior. So that is picking up all the regional German data. Spain, Spanish inflation, that was still too hot. So we're just seeing a reaction to that. That's why German 10-year yields are moving higher this morning, about 3 basis points rather. UK 2-year yields, this was a weird thing because yesterday when Andrew Bailey was saying we're going to be higher for longer than what most people expect, more or less, we actually had buying on the front end of the curve. So finally, maybe a little bit more reasonable. It makes more sense, the action we're seeing today. But again, Kriti, I go back to this idea that it's just a lot of month-end weirdness. And finally, so that was the inflation data. We also had a Riksbank decision. They're going to be unwinding their bond balance sheet more quickly. But even so, the krona barely stronger. The Riksbank pointing out a weak krona is an issue for them, Kriti.
Right, and of course, something that brings us right back to the European inflation battle and perhaps some of the commentary we saw out of Sintra as well. I want to bring in a true expert to break it all down. Economics editor Zoe Schneeweiss joins us from Vienna. Zoe, Spanish inflation back below 2%. Is the crisis over? How does the ECB interpret something like that?
Yes, the Spanish data really is quite remarkable. Just a reminder, a year ago, Spanish inflation was above 10%. It peaked last July at 10.7, and now it's down to 1.6%. Why is this happening? So it's partly a base effect here. We compare with inflation, as a reminder, we compare with a year earlier, and that just means that those very strong energy prices we had a year ago now no longer are in there. Is this crisis over? Not really. The base effect means that actually by the year end, Spanish inflation probably will be around 4% again, and being sustainably below that 2% target that the ECB has is probably still a year away. But then also as a reminder, the ECB does not target a specific country. It's the region as a whole. Now, in the region as a whole, you already touched on German data. Germany will actually see an acceleration in June. Again, it's the base effect. A year ago, there was this super cheap ticket in Germany where for €9 you could go, or you could use public transport for that. We had that in June, July, and August last year. So this year they have a new ticket, but that's €45 versus those €9. So again, the base effect means that now June, July, and August will see way stronger inflation readings.
Hey, Zoe, the Riksbank governor is speaking just at this moment at a news conference saying that CPIF could be moderating slower than we thought. Of course, in the decision, they talked about the weak krona, the issue that had from them. We're barely strengthening in the krona after this decision. How big of a problem does Sweden have on their hands, Zoe?
So on Sweden, some economists were predicting that they actually could have done 50 today. So 25 is something that might be disappointing a little bit. At the same time, though, as you mentioned, the Riksbank said that they would be cutting down on their bond portfolio more quickly than anticipated. Overall, in all these countries across Europe, be it in the euro area, be it Sweden, that's not in the euro area, we have the issue that inflation just is more persistent than they think. And that really is a problem for policymakers across the region.
Certainly something we're going to keep our eye on. I have to say, a job I do not envy for anyone around the world. Zoe Schneeweiss joining us from Vienna to break it all down. We thank you. From Europe, we go right back to the United States. The big banks all passed the Fed's annual stress test. However, many have warned that they will probably hold off on announcing potential payouts until they get more clarity on those new capital requirements. Joining us now to break it all down, Bloomberg's Sonali Basak joins us right here on set, waking up bright and early for us. Look, before we get into the nitty-gritty, one of the concerns around the last round of stress tests was that perhaps the doomsday scenario wasn't doomsday enough. What was the doomsday scenario here?
Well, we did have a steeper drop in GDP, but one of the problems here is the interest rate testing, given the sharp volatility we've seen in rates and the bond portfolios that many of these banks have. Now, remember, the stress tests themselves test banks with over $250 billion in assets, and that leaves a lot of questions about banks that don't have that many in assets and are perhaps more vulnerable to some of these scenarios. I will also say, on the heels of these stress tests, one good news here is that all of them have passed. But then you have groups like Better Markets that are quite frustrated and saying that is a quite misleading result given all the stresses we've already seen in the banking system and the all clear here to try to give banks more ability to return capital to shareholders on the wake of an all clear like this.
Well, to that point, Sonali, there's a couple more things we need to wait for, right, to get that all clear. The FDIC insurance fund, the capital requirements. What do banks want to hear from those things that do give them the all clear to return shareholder capital?
Well, there's a few things. There's the international capital rules. Also, there's Basel III. Then there's more from the Federal Reserve to hear about the direction of travel here when it comes to more capital requirements. There are a couple things that are interesting here, Danny, and one of them is this idea that there were so many banks also that really hit their minimum Tier 1 capital ratios in these tests, which means that they might look to go to the bond markets to kind of boost their buffers here. They might hold off a little bit when it comes to more strict capital return. I would also say an interesting dynamic here was that exploratory market shock, because even though we did definitely see all these banks pass that market test, we did see out of more than $540 billion in potential losses here in this adverse scenario, almost $100 billion just came from that exploratory market shock faced by the banks with such big trading desks. So certainly a big amount of losses to bear by the world's biggest banks, the United States' biggest banks, and a lot of questions around how much capital will be required to hold against these trading desks in the future, let alone from this year as we look for the Fed to change some of these rules.
Sonali, thank you so much. That is Bloomberg's Sonali Basak. Now to the world of tech. Micron gave an upbeat forecast even as the chip maker continues to face challenges in China, signaling that an industry oversupply is starting to ease. Let's get now to Bloomberg Quick Takes' Alex Webb. Setting the China story aside for a moment, is this all clear, not just for Micron, but for some of the greater supply industry issues for this industry?
I mean, it certainly looks that way. Essentially, the market was expecting revenue of about $3.9 billion in the fourth quarter. Sales are likely to be above that, $4.1 billion. That's even as Micron faces some headwinds in China. It seems to have become something of a victim of the contretemps between China and the US over semiconductors. And because the space they're in, memory chips, is highly commoditized, there are lots of companies who are able to do this. The three big players, of which they're one, that means it's been quite easy for China to sort of make it harder for them to get into the market. The thing you've got to remember about Micron, which is a kind of mind-boggling number, their revenue in the 12 months through June have fallen 44%, right? Not through June, of course, sorry, through May.
Right.
But it's fallen 44% from a year ago. And they've been trying to make the case for some time that the boom and bust cycle in chips was over. This is clearly not the case, particularly in memory chips.
Yes. Well, let's bring the China piece back into the equation here, Alex. I think when the sanctions or the blacklisting headlines first initially hit, a lot of analysts had written that off as saying, well, it only makes up about 10% of Micron's revenue. How big of a deal could this be for a company that still is kind of investing and expanding in that country?
Yeah, the issue is always, it's basically, if you've got struggling growth, of course they're shrinking at the moment, and China is, perennially still, when it comes to electronics, a big growth market. You can't grow in that market because there's pressure, then of course you've got a bit of a problem. The CEO said that China is a kind of low double-digit percentage that is likely to be affected as a consequence of this. So, that's a big chunk out of the opportunity, the upside opportunity. It's clearly not the lion's share of its business. Shares are trading up. Some of the analyst coverage coming out of it didn't seem actually that optimistic given the share reaction, but the overall message seems to be things aren't quite as bad as everybody had expected.
Okay, Alex, thank you very much for that update. That is Bloomberg's Alex Webb. Now, coming up on the show, we're going to catch up with TD's Pooja Kumra on why she sees no more rate hikes from the Fed this year. And the UK's biggest water supplier is said to be in talks over contingency plans as its debt pile surpasses £13 billion, or almost $17 billion. We're going to have more on that ahead. This is Bloomberg.
For the first, call it 18 years at Chipotle, this was you come into Chipotle along the line, you interact with the crew, and you customize your meal. We've got this separate make line, and it's digitized, and so the orders come in, and they're really kind of staged so that if you say at noon, I want to come in at 1 o'clock, we hold that order, and we will send it to the crew like maybe 10 to 1,
right.
So it's ready right when you pull up your car.
How do you manage these kind of two different staffing needs, right?
Yes.
And making sure you have the right amount of people
Yes.
at the right time.
We spend a lot of time projecting sales. A lot of it is, it's part art, part science. We're trying to bring more science and more AI into it. Because if you get the right sales projection, then you know exactly what your staffing needs to be. So if you get the sales right, you can get the entire restaurant staffed perfectly. With just a couple people, our average restaurant now does about over $1 million per restaurant in digital sales.
People ask me all the time, what is the key to being a really good investor? And I tell them it's to surround yourself with and work with the best investors you can find. On Bloomberg Wealth, I'm going to take you to meet the greatest investors in the world, the people that I would like to have managing my money.
Today, I would say perhaps only second to AI right now, which is AI has got so much going on that folks are so excited about it. Climate tech is the hottest area to be in.
The moment news breaks, no one covers the world like Bloomberg.
The image of Vladimir Putin as the all-powerful leader has been rattled already.
History was made here at the federal courthouse in Miami when Donald Trump became the first ever former president to ever be arraigned on federal charges.
We're going to need a new engine technology, and that's where the real battle lies. And whoever makes that decision first is going to have a huge impact on this industry.
Bloomberg, your global business authority.
This is Bloomberg Surveillance Early Edition. I'm Kriti Gupta in New York with Danny Berger in London. Look, a lot of the commentary you're seeing in the bond market is really on the heels of what you heard in Sintra, Portugal, where all of the central bankers, the major ones at least, really talk about this hawkish rhetoric. We kind of knew that. We knew that they were going to stick to that tone, but they did it to varying degrees. And I think something that really stood out for me in that panel was Chairman Powell saying, look, the progress that's been made in the labor market is encouraging, something that has been noticeably sticky in the last year or so. And I want to kind of, for our TV and radio audience, put that into a little bit of perspective. Initial jobless claims, we are due that data in just a few hours. Well, it's been ticking higher for the last couple of weeks. That is positive news from an economic perspective, simply because the Federal Reserve needs that softening in the labor market. Now, look, it's only been a few weeks, so you are seeing this kind of increase in those claims, at least when it comes to the 4-week moving average, but will it stick? And that's going to be a major question. At the same time, you are seeing the same labor issues become something to worry about in the ECB, the BOE, et cetera. I want to bring in a true expert, bring a little bit more analysis. Bloomberg Markets Live editor Noor Al-Ali joins us. Noor, how much can we read in to this kind of labor market softness progress, for lack of a better term?
Well, look, I mean, you're absolutely correct. The Fed does have a dual mandate. It's got a lot on its plate. But, you know, as well as that jobless claims or jobless data shows a tick higher, which is what the Fed has been wanting to see, but also you see that, you know, labor costs and labor costs going higher, productivity going lower. And that's an issue, of course, on the long run, because you still have inflation still ticking much higher than the Fed likes to see. And, you know, we had Powell come out earlier today, doubling down on comments that he's given a couple of weeks ago. And he said we might see, you know, 1 or 2 more hikes this year. And I'm not discounting that at all. I think we're definitely in a zone where we still need to see more affirmative action from central banks perspective, and that's what treasuries are telling you, particularly on the short end of the scale.
Noor, I mean, it was really remarkable to see this hawkish choir yesterday on that panel, except for Ueda. I mean, how much of the story of the rest of 2023 is going to be about central bank divergence rather than cohesion about moving higher?
That's absolutely spot on, Danny. And I just want to know, I loved watching it. You know, I was away from my desk, but I had to run back when I saw people saying, oh, it's hilarious. And I was like, wait, hold on, monetary policy, hilarious? I've never laughed while studying this stuff. So it was really nice to see a bit of an ease into these very difficult conversations that we're having, particularly with the Japanese yen here, Bank of Japan, and the PBOC. You're definitely seeing that diverging theme really play out between the Western developed central banks and their Asian counterparts. You know, PBOC really coming in, stepping in higher in the fixing for the yuan rate. They're really trying to prop up the currency. You know, we had the finance minister come out earlier from Japan, you know, intervene again verbally with the Japanese yen, but you're seeing markets push back here. And I think that's going to be a very important theme coming into the second half of the year. Just how much action do central banks or, you know, officials in total, because the BOJ told you it's not our purview, it's the Ministry of Finance, but obviously it's something that they're watching very closely.
Right, and of course, you know, the Ministry of Finance and the BOJ don't have the same separation as we see in other regions with central banks. Nor, you teased up our next conversation perfectly. We're going to get into the jokes after this next commercial break. Noor, thank you so much. That's Noor Al-Ali. And for more market analysis, check out MLive Go on your terminal. The jokes are next. Stay with us. This is Bloomberg.
Business Week Radio, live weekday afternoons at 3 p.m. Eastern.
We got a little bit of talking.
Come on, are you guys ready?
Harnessing the power of Bloomberg Business Week, Carol Masser and Tim Stanovic bring you the latest news from the worlds of business, technology, politics, and more.
How does the Fed play into this and what the Fed does potentially?
This is so exhausting and this is so all-encompassing.
Listen on Bloomberg Radio and streaming on YouTube and Bloomberg Originals.
the EU is one of the largest and wealthiest consumer markets in the world, and there are very few global companies that can afford not to trade in the EU. So as the price for accessing the European market, these companies need to obey European regulations. That's not surprising. But often these companies choose that they will extend the European standards across their global conduct and their global production because they want to avoid the cost of complying with multiple different regulatory regimes. So there are benefits to standardization, benefits to uniform production. So all the EU needs to do is to regulate the single market. And it's then the market forces and the business incentives of global companies that transform that EU rule.
On the David Rubenstein Show, Peer-to-Peer Conversations, I uncover the untold stories of the world's most successful leaders. Watch Wednesdays on Bloomberg Television.
From our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West, only on Bloomberg Television, your global business authority.
This is Bloomberg Surveillance Early Edition. I'm Danny Berger in London with Kriti Gupta in New York. Now, the ECB forum wrapped up with a panel with the heads of the world's 4 major central banks. And if I were to tell you that the one that got the most laughs out of all of them was BOJ Governor Kazuo Ueda, would you have believed me? That's exactly what happened. Take a listen.
I didn't know there was going to be so much traveling and so many press conferences. The yen is being influenced by many factors other than our monetary policy, including the policies of these 3 banks. So we'll see. We haven't had any serious monetary tightening for 3 decades. So in terms of that, the lag in the effects of monetary policy could be at least 25 years.
I love anyone that takes a dig at the idea of long and variable lags because it is silly, but Kriti, the bar is so low to be funny for a central banker. It is maybe way too low.
I gotta say, I think the highlight of that moment was just how much of a laugh it got out of Christine Lagarde, just to the fact that she really kind of almost, I feel like, was 2 minutes away from giving it a standing ovation. But Danny, I think to your point, it is kind of a very low bar, and I think the BOJ here is really struggling with the fact that they're kind of grouped into even this panel, but dealing with very different issues than the BOE, the ECB, and of course the Federal Reserve.
Yeah, and of course Ueda is a guy, look, he's been an academic for a long time. He was on the BOJ a long time ago. Kind of the idea that he first started joking there of getting back into the circuit. I mean, you can see why he might be a little bit shell-shocked about that one. All right, Kriti, from the macro jokes to some more of the micro stories, let's get into some of the top European corporate news. Siemens Energy's wind turbine concerns are growing. Now, executives at the firm are worried that fixing the issue may far exceed the previous estimate of 1 billion euros. That's according to Bloomberg sources. And Kriti, in reaction to this, because of course we learned about the $1 billion issue last week, is now they're starting to reduce their exposure to Gamesa, which is the wind turbine unit. So they're trying to fix it, but Siemens Energy shares, they are down today pretty decisively.
Yeah, that 1 billion or 1 billion euro story is pretty fascinating, especially when it comes to the idea that, I mean, you said this before, it was already reported, but this is going to be a longer term fix. I mean, the size of some of these wind turbines, just to really water it down and simplify, to have this fix in all of them is a real undertaking. And not only will it cost money, it'll cost time as well, which is never positive from the investor standpoint.
Today really feels like a day where we're just examining European utilities. Kriti, you pointed out the excellent lead into the story for Bloomberg that essentially it's because these things are shaking. They're not supposed to be shaking. They're supposed to be turning. And Kriti, of course, later in the show, you and I are also going to be discussing the drama at Thames Water. There are issues there. It long stems from all the debt they have piled up. Politicians are reportedly discussing now nationalizing it. But Kriti, given everything that's happened with the war, I mean, infrastructure in Europe, it is at still a crucial moment.
Right, and that infrastructure spend, I think, is crucial as well. When we're talking a lot about fiscal budgets that are really stretched from France to England to, I'm sure, the periphery as well. So a lot of pain for a lot of these countries that are really looking to kind of step into the future with some of this renewable energy.
Yeah, exactly. I mean, look, it's a big headache, and we're working our way through it. All right, coming up on the show, we're going to turn our focus back to central bank policy paths, rather. We're going to be speaking with TD Bank's Pooja Kumra next. This is Bloomberg.
Venture capital. It's been volatile. From bank crisis anxiety to AI exuberance, Caroline Hyde and Ed Ludlow chat with the biggest names about the latest tech trends.
Is AI going to dominate the earnings narrative for this sector this week?
I think we're seeing opportunity and potential platform shift that we haven't seen in a long time.
If you're a company today and you're not embracing the changes that are taking place with AI, you're going to be behind.
How do you prove to the investor base that you haven't just tacked on AI to make yourself sexy?
It's very hard to differentiate if you're not experienced with AI.
The startup stories.
We think this is a watershed moment for technology.
Certain categories are more exciting than others. Right now, obviously, generative AI is a category that is very exciting to startup founders, customers, and venture capitalists as well.
So what we are seeing is a new area of opportunities for new founders to come and change the industries that matter.
And the real talk on realistic valuations.
Some of the best opportunities are sitting right in front of us.
How do you discern which ones are good on the marketplace right now?
I think founders have woken up to the reality that taking on more money at higher terms doesn't necessarily play to their benefit in the long run.
How do you actually invest?
Follow the VC money on Bloomberg Technology, the only daily business show dedicated to tech right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West, only on Bloomberg Television.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
This is Bloomberg Surveillance Early Edition. Here's what you need to know. Top central bankers beat the hawkish drum, saying they have ways to go in reining in too high inflation. New CPI data from Spain and Germany adding fuel to the debate. And Wall Street's biggest banks all passed the Fed's annual stress test with flying colors, clearing a key hurdle for returning billions of dollars to investors. Meanwhile, the chips are up. Micron delivers as upbeat sales forecast in a sign that industry glut may be easing. I'm Kriti Gupta in New York with Danny Berger in London. Danny, it does feel like some of the micro stories are coming back, but really the hawkish take in Sintra perhaps moving the market a little bit more.
Yeah, I'm surprised it didn't move it yesterday. If anything, the market reacted to the opposite of what you would expect it to. We'll get into that in just a bit, Kriti. But we are now seeing European stocks moving higher. I mean, marginally 0.1%. UK underperforming, some utility issues there. Of course, utility issues for Gamesa too. Now, the Swedish krona, it's now losing steam. It is now falling versus the euro. This is a problem from Sweden. Riksbank hiked today by 25 basis points, but they also started QT, and they're, of course, selling off their bonds more rapidly at this moment because a weak currency is an issue for them. They are importing inflation at a time when they're trying to combat inflation. Perhaps they need to do a jumbo hike. Perhaps today wasn't enough. Now, we've also been getting some regional German inflation numbers throughout the day. We also got Spanish inflation back below 2%, but core, it is still sticky. The regional German data, that is hotter too. We're going to get the full picture at around 1:30 p.m. UK time. So in the meantime, selling bonds both in Germany and in the front end of the UK curve, Kriti.
Yeah, certainly something that we're going to be digesting. What's really important here for the States is going to be kind of how you play this and how you see the fallout in terms of the equity market. Look, you're looking at futures in the NASDAQ space higher by 0.2%. But again, similar to the dynamic you're talking about, Danny, yesterday there didn't seem to be a much of a positive reaction that you're seeing today. But even if you look at the benchmark S&P futures, for example, they aren't moving in the positive direction by that much. So that's going to be something to keep in mind. The 2-year yield at about 4.77 is going to be crucial here, because as you see yields higher by about now 6 basis points, that hawkish rhetoric that we're seeing in Sintra getting repriced very, very quickly. I wonder how much of that story is going to continue as we talk about this divergence from central banks. Sure, they're all hawkish right now, but in the future, at some point, one of these banks, the Fed, the BOE, and the ECB, we'll put the BOJ on the side for now, is going to be slowing down faster than the others. And I wonder, again, what that might mean for a country like China, for example. Overnight, the PBOC giving its third fixing, strongest fixing, I should say, for the yuan this week, 725 on that currency pair. So certainly something that we're going to be watching, as essentially it's been made clear a weaker yuan is not acceptable to the PBOC. We come back to the recession story. NYMEX crude is always our really great gauge for that 69 handle there, pairing some of the gains we saw just 30 minutes ago, but still in the green, but just marginally, Danny.
Well, let's get back to the central bank story, because several of the world's top central bankers say that resilient economies are keeping inflation too high and more monetary tightening will be needed. Christine Lagarde, Jerome Powell, Andrew Bailey, and Casio Ueda spoke at the ECB forum in Sintra, Portugal yesterday.
We still have ground to cover.
Although policy is restrictive, it may not be restrictive enough, and it has not been restrictive for long enough.
We are data dependent. We will decide on a meeting-by-meeting basis.
We will be evidence-driven, so we will wait for the next set of evidence for our next meeting.
Underlying inflation is still a bit lower than 2%. That's why we are keeping policy unchanged at the moment.
If our baseline stands, then we also know that we will very likely hike again in July.
We're going to move the decisions a little bit, make them with a little bit more time in between them.
We will do what is necessary.
I wouldn't take, moving at consecutive meetings off the table at all.
So the stars there of monetary policy. Let's get to a star of rate strategy. It's Pooja Kumra, Senior European Rate Strategist at TD Bank. Pooja, thanks so much for joining this morning. All right, so perhaps it wasn't surprising we saw some hawkish language from those central bankers, but they did step it up. Maybe what was surprising is what rates did yesterday. Yields fell. We were buying the front end, again, as Bailey, Lagarde, and Powell all said they were going to be more hawkish. What do you make of that price action?
So, yes, rates never make sense, that we figured. But I think yesterday, a couple of things that I noted was, first of all, we do need to be a little more cautious ahead of month end as well as quarter end. Your moves can be exaggerated for no particular reasons. I think what was leading the rally is also the move in gilts. I think markets were expecting much more hawkish tone from Bailey as well as Phil. Again, we got no insight into how they were thinking, and that's why if you see on a cross-market basis, gilts did perform the most. And I think generally the rhetoric was hawkish, but I think yesterday markets thought it was pretty much similar to what we have heard from them mostly. But I think where we are trading right now, it's going to be choppy. We are actually going to just trade each and every data point. And I think at this stage, we need to accept that most central banks need to sound hawkish, primarily because they don't want markets to price in cuts. They all mentioned yesterday that they don't expect inflation to be at the 2% target this year or next year. So I think the worst thing that they want markets to price right now is cuts. And I think that's where the hawkish tone sets in.
Okay, so with that, Pooja, then, are you a doubter? Do you doubt the fact that they're going to go 2 more times, and maybe that was just a tool, again, to make sure the market didn't price in cuts?
So the thing is, in the June meeting, they had so much evidence versus the payroll report and CPI. So the key question is, why didn't they go in June?
Exactly.
And that's where, heading into the July meeting, we don't see that the Fed will have much more evidence. The first thing will be tomorrow's PCE number, which is likely to see a further slowdown from CPI, which came in at 0.4%, and it should likely to come into 0.3%. And similarly, we will see another slowdown in July CPI report as well as unemployment report. So I think the basis right now, if Fed just wants to be hawkish and hike, that's different. But I don't think the data is any different or stronger than what they had in June. I think the turning point for markets will definitely be going into the Jackson Hole in August. I think that's where most central banks will try to give us more direction, because whatever they said that they want more evidence of slowdown, I doubt they will get that in the next 2-3 weeks. Data will be choppy, which means rates will be illogical.
Well, Pooja, in terms of kind of rates being illogical, it feels like the sentiment right now, especially around the Federal Reserve, the BOE, and the ECB, is that they're all on the same page, being hawkish for longer, higher rates for longer. But Danny and I have been asking almost all of our guests this question: at what point do they start to diverge, and when does that become a problem? Although I feel like from a trading perspective, I might be an interest rate strategist dreams, a very easy trade to make. But from an economic perspective, when should we be concerned about it?
So first thing is, I think divergence will happen. I'm not hoping for, but if we do see certain shocks, like for example the SVB crisis or the LDI crisis that we saw. But so far we have seen that we have coped really well. I think we could see more divergence coming in if we do see more significant slowdown, especially in Europe. The PMI services have started to slow down pretty aggressively. We have also seen core inflation as well as the headline inflation is actually working as what ECB wants. So I think that's where we could see a little more divergence setting in. But I think the next 3 months, it's hard to see the general rhetoric changing from any central bank. And I think what we also gathered from Sintra yesterday is that all central banks do talk a lot. They do discuss the route forward, and I think they are all addressing the same inflation, sticky inflation problem across board. So I think next 3 months, it's hard to see much divergence. And I think after that, we will be seeing how different interest-sensitive sectors get hit across board. Like, for example, something that we have been seeing, that households still have longer-dated mortgages in Europe as well as in US, but in UK, we have short-dated mortgages. They will get hit by the end of the year. So I think that's something that's more likely to play out in Q4 rather than right now in Q2 or Q3.
What did you make of kind of the longer-term levels that Chair Powell had specifically spoken about? I feel like the Federal Reserve for a very long time has had that reputation as central banker to the world. He said we might not hit that 2% inflation target until 2025. Is that a timeline that works for the rest of the world, Pooja?
Well, I think they do have to say that as per their forecast. It's not a timeline that it works, but I think they're still trying to stick to the 2% level. I think they need to tell markets that when it comes to their wage expectation, they should keep in mind that the 2% is still their target. But the fact that they are not reaching 2% by 2025 across board, which also means that they will have to sound hawkish irrespective of this. I mean, they will have to turn a blind eye to a slowdown. And that's where I think the move here for rates is potentially higher till we see any move lower when it comes to rates, if we do see this hawkish rhetoric, and especially with markets actually just reducing their cuts from Fed curve every single day for December. So I think we've moved a lot when it comes to December pricing for US.
Well, I guess some of the hawkish rhetoric has worked then. Pooja, I'm afraid that's all we have time for. Thank you so much for joining this morning. It's great to see you as Pooja Kumra of TD Bank. Now, coming up, we're going to get more on London's water crisis as the UK mulls nationalization of Thames Water. This is Bloomberg.
Sports and money. They've always gone together.
But never before have sports been so massively influential and as lucrative as they are today.
NFL, NBA, none of them were what they are today when they were born.
There's leagues that are being thought of and built every day.
New teams, new leagues, new business models, even entirely new sports.
I never in a million years would have thought this is what my life would be like.
We set out to find what's happening and what's about to happen at the nexus of business, sports, and culture.
Getting involved from a business perspective was something that was very natural and an easy transition for me.
From the pickleball courts of Arizona,
to the kabaddi tournaments in India,
to the cornhole boards at your local tailgate. This is what's next in sports.
Lots happening on Wall Street.
There are so many factors at play today.
It remains tight in certain parts of the economy.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insight.
Crisis is too strong a word, and words like that get used a lot.
From businesses most influential and instrumental.
America's economy needs a diversity of institutions.
That's something that Wall Street pays a lot of attention to.
Bloomberg Wall Street Week, live Friday with replays all weekend on Bloomberg Television and Radio.
This is Bloomberg Surveillance Early Edition. I'm Danny Berger in London with Kriti Gupta in New York. Now, Britain's biggest water company is facing a crisis more than 30 years after it was privatized. Joining us now for more on this is Bloomberg's Eamon Farhad. Eamon, thanks so much for joining. Look, this is one of those things, you know, I get the bill that comes in the mail for Thames Water. It's water, it's a utility. You don't think about it. How did we get to the point where they're in crisis mode now?
Yeah, so as you said, since privatization about 30 years ago, lots of the infrastructure, you know, fixing your pipes, all of this stuff has been funded largely by public debt. Now for Thames Water, that's amounted to £13 billion of public debt, and it's got the highest ratio of debt to equity, of any water company in the UK. Some of that debt is linked to inflation. As you know, rates are going up, so they're in a very difficult situation.
So give us some background here. I mean, that's been kind of the macro theme for a while, but how did we get here with this particular issue?
So right now, water companies in the UK, the way that investment works is every 5 years they present kind of a business plan to the regulator Ofwat. And right now we're kind of getting into that next business plan for the 2025 period, which will be presented in October. Because of that, all the companies are kind of going through their reports, looking at their results. And I guess at this point for Thames Water, it looked like their financial resilience just wasn't where they wanted it to be. So all of this has kind of happened in the last 24, 48 hours because of that.
Yeah, so I mean, it's quickly evolving. I know we've reached out to some of the investors in Thames Water. If they're watching, they're more than welcome to come join us, and basically just pointed us to the statement from Thames about press speculation. Yeah. But what do we actually know? What are the talks that are going on? What are the options for Thames Water?
So the government really is trying to push it back to try and find some kind of market solution. You know, they're saying that Thames Water is talking to their equity investors, trying to find more equity. Now we do know that the government is also considering nationalisation. Nationalisation, that is an option. You know, this is a vital infrastructure piece for us in the UK, especially in London. You know, they serve over 50 million customers. So that is definitely a last resort, though, because obviously that pushes it back onto the taxpayer, back onto our pocket, back onto our bills.
Yeah, and especially in this political climate, asking for even more tax, putting it onto our bills at a cost of living crisis is certainly a politically tricky maneuver. Eamon, thank you so much for your excellent reporting. That is Eamon Farhad. Kriti.
Yeah, certainly something we're going to be keeping an eye on in terms of, I want to say, the read-through in the energy story in Europe broadly. But stateside in the U.S. politics, China is back again. Spy balloon that floated over the U.S. earlier this year. Well, turns out it was equipped with American-made surveillance gear. That, according to the Wall Street Journal. Joining us now is Bloomberg Asia government and politics correspondent Rebecca Chung-Wilkins. Rebecca, this story has really kind of evolved so quickly. Turns out China had spy balloons and the U.S. has spy balloons. Why is the technology so important here?
Absolutely. I mean, one of the uncomfortable truths, I think, that this report shows up, and the whole incident about, you know, respective spy balloons, is that it is deeply difficult to untangle and disentangle the reliance of the US and China on one another's technology. The uncomfortable reality that we are facing up is that both of those nations use technology produced by the other in strategic areas of tech. And it's also kind of hits at the fundamental issue of all of these curbs that the Biden administration is pushing out too. It is very, very difficult to effectively enforce that.
How does this lend itself to what the U.S. is trying to do and limit chips further? We had more news. We spoke about it with you yesterday, Rebecca, about NVIDIA, about some of these AI chips. How much of that is correlated to just seeing the sheer amount of U.S. technology in this balloon?
I mean, I think part of it and part of the optics of this story that really captured people's imaginations was that it was such a spectacle. And I think in that context, it's hard, it's so hard to ignore. It is such a sort of obvious reminder that the US is really still exposed to Chinese supply chains in ways that it deeply finds deeply uncomfortable and in ways that potentially risk its national security. So yes, of course, linked, as you say, to the broader push by the US to curb other forms of technology, AI, namely, we were talking about yesterday too. There is also this sort of ongoing issue over precisely what data the Chinese balloon, was able to transmit using some of this US tech too. Now, contradictory reports here, the latest from the journal citing officials saying that actually the balloon wasn't able to transmit, but we had heard something contradictory previously. So that will be another question, is precisely how this US technology was used.
Well, speaking of that story, I mean, what does the pushback here look like? Do we expect to hear more from the Chinese government, from the U.S. government? What is the political fallout now that we have these details?
Well, it's really interesting. I mean, Beijing so far has been relatively muted in its response to all of these attempts to constrain China and contain China. Really, the most sort of meaningful action we've seen is them taking that restriction, that cybersecurity probe against Micron, limiting their distribution of some of those products to Chinese clients. Now, today, however, we saw this new foreign policy law enacted by Xi Jinping. It's not sort of necessarily new, but what it does do is draw together all of these tools that are already being implemented mainly as regulation or guidelines under one single framework. And the fact that we're seeing this comprehensive umbrella emerge does suggest that China is sort of preparing to start fighting back in a more comprehensive way. If you place that alongside this renewed request by China that the US lifts its sanctions on against China, the implication there being this one specifically on China's defense minister, you can see this combination of one comprehensive framework, specific and more frequent asks being made of the US. The pushback is starting to really come into fore, and we may start seeing some of that retaliation have a bit more bite to it too.
Okay, Rebecca, thank you very much for that update. That is Bloomberg's Rebecca Chung-Wilkins. Now, coming up, more inflation data out of Europe on deck. We're going to get to your daily brief next. This is Bloomberg.
Let's go inside the boardroom. Let's suppose you win a proxy fight or you just get invited onto the board. You go to your first board meeting, and you're the person who's saying you can fix this company, and all of the others on the board of directors are saying, well, we're doing pretty well. How do you get received when you start saying, here's what I wanted you to do?
Well, first of all, we don't bring that to the boardroom. Our time is spent with the CEO, the chairman, the CFO, and share our plans with them outside the boardroom. We try never to solve an issue in a boardroom, okay? It's always best done the day before, the week before, outside that room. We wouldn't be there if they really were doing well. So it's really hard for them to straight face and tell us we're doing well. And we present them with a plan.
From the world of politics to the world of business, every weekday at 5 p.m. Eastern Time, hosts Anne-Marie Hordern and Joe Matthew alongside Kaylee Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power, every weekday at 5 p.m. Eastern Time, only on Bloomberg, your global business authority.
This is Bloomberg Surveillance Early Edition. I'm Danny Berger in London. Kriti Gupta is in New York. Let's get a look at what's ahead today. Now, we're going to get another CPI print out of Germany. That will be around 8 a.m. Eastern time. We've already seen some of the states come in hot, so likely this data point will come in hot too. Now, that's going to be followed by U.S. GDP. We're also going to get core PCE and jobless claims at 8:30. Will those jobless claims confirm the tick higher we've had in the jobless rates? Then Fed speak continues. We're going to get Atlanta Fed President Raphael Bostic. That'll be at 3 p.m. Eastern time. And finally, Nike reports earnings after U.S. market close. Kriti, you've been buying some Nike sneakers as of late. You're going to be supporting this one?
You know, I got to say, fun fact here, I bought a pair of Nike factory sneakers in college, and I have loved them so much, and they are so worn out that I'm actually in the market for a new one. How did you know?
Wait, what's a factory sneaker? I have no idea.
It's like their outlet store. Like they're, because I'm very cheap.
Look at you, so economically savvy, Kriti.
Yeah,
I love it.
This is what happens when you have Indian parents. It just kind of comes naturally through the blood. We should mention the stock market performance, though, because as you said, they are reporting after the bell, but the stock is already higher by 0.4% in pre-market trading, so certainly some movement we're going to be watching in the next, I want to say 12 hours or so. But let's stick with that earnings story, Danny, and talk about Micron here, because that seems to be the big mover this morning, especially after they come out and delivered a pretty strong forecast. Turns out that glut that we were worried about may not be as big of a problem, higher by 3.6% on those shares. The ticker there is MU. What's interesting to me, though, is that even with all the China pushback, they're still expecting to really outperform.
Yeah, maybe just a lot of that China stuff is priced in because they are losing a lot from China, from being unable to sell to them. But that glut in supply chains, it really is that pandemic bullwhip. It's just another example of some of that is finally easing. You know, we have some of the inflation figures coming down and supply chains coming back to life. It's great news.
Yeah, it's positive, especially if you view them as that kind of economic bellwether. And it's going to be kind of a similar story when you look at the banks, for example, which again are also higher in the pre-market. This, of course, coming off the stress test. It looks like they passed with flying colors and in a move that they're potentially able to return some shareholder value. The underperformer here, though, is Citi shares. The ticker is just the letter C, down about 0.5%. But if you look at some of the kind of the more regionally exposed banks, Bank of America, Wells Fargo, they're outperforming by 1% or higher. So some good news, Danny, when it comes to the banks.
I guess the thing, though, is in terms of these banks actually returning shareholder capital, it's not the all clear yet. There's a lot of things they need to wait for. We heard in Powell's Senate testimony that some of these large players are going to have capital requirements, something like up to 20%. He didn't give a lot of details, so we need to get our hands on that. And then, of course, there's the FDIC special assessment. How much, again, focus on these large banks, are they going to have to contribute to the insurance fund? Until we know those figures, until the banks know those figures, they can't really say how much capital they're going to be able to return.
Yeah, and that's going to be crucial as we talk about, again, what is that doomsday scenario that they're really testing for? Because remember, even before that regional banking turmoil, these banks, again, passed with flying colors. Certainly something we're going to be keeping an eye on. But speaking of regulation, Danny, a case that we've been covering all week long, one of my personal obsessions this week has been the FTC kind of hit or case against Microsoft and their $70 billion acquisition of Activision. Look, we are on day 4 of testimony as of yesterday. yesterday. Day 5 is today. We're expected to get closing statements today and potentially a verdict as early as this evening. Microsoft shares down a little bit. Activision Blizzard shares up. Again, not moves I would write home about, but to me, there's a quote that came from the CEO of Microsoft, Satya Nadella. If you'll kind of indulge me here, let me read it out to you. He said, "If it was up to me, I would love to get rid of the entire exclusives on consoles, but that's not for me to define, especially as a low share player in the console market. The dominant player there, Sony, has defined market competition using exclusives. That's the world we live in, and I have no love for that world." Satya Nadella with some fighting words for Sony, Danny, but I think it's important to say, look, he didn't make the rules. This is the way the gaming market works, and that's going to be something that's really scrutinized in today's testimony.
Kriti, can I just say, I love how much you love this story. Every morning, folks, I get an update from Kriti on what's happening with the Microsoft Activision story, and I am here for it. All right, that is it for Early Edition. Surveillance is up ahead with Deutsche Bank Global CEO. This is Bloomberg.
We're not going to be relying upon countries whose values we don't share.
To the world of business.
It's all about corporate power at the end.
Balance of Power, live from Bloomberg's Washington headquarters.
We're going to be more excited what's in store for you.
How long will it take? How many years? Why don't we take this one day at a time?
Good luck. Everybody has a perspective.
Every weekday at 5 p.m. Eastern Time. Join hosts Anne-Marie Hordern.
It's the one area, really, of bipartisanship.
I think we're getting more, but
that's optimistic.
And Joe Matthew.
The debt ceiling is looming. How close are we going to get to the line before you start to worry?
Alongside Kaylee Lines.
The door was open for regulators to do more, and that puts the Fed between a rock and a hard place.
As they deliver news.
This is such an important economic issue.
He's no longer trying to run away from
that. Really blew some minds.
Insight.
We can both invest in law enforcement and also make sure that communities feel safe in their own skin.
And analysis.
I think your audience will get this more than most.
This is not the Republican Party that you know.
It allows him to do what he did so successfully in 2020, which is run against crazy.
From and about politics' biggest power players.
This was the zombie case, and it's now more than well alive.
That's for sure, with 2 more potentially to come.
I'm willing to have this battle.
It is vitally important. This is the intersection of Washington and Wall Street.
Bringing people directly to the decision makers that impact your investments and your life.
Balance of Power, every weekday at 5 p.m. Eastern, only on Bloomberg, your global business authority.
Although policy is restrictive, it may not be restrictive enough, and it has not been restrictive for long enough.
We have to be as persistent as inflation is persistent.
It is a worse outcome if we don't get inflation back to target.
We believe there's more restriction coming. I wouldn't take, moving at consecutive meetings off the table at all.
We have covered a lot of ground, and we still have ground to cover.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Good morning, everyone. Jonathan Farrell, Lisa Abramowitz, and Tom King. Jonathan Farrell on assignment this morning. Lisa Abramowitz on assignment this morning. And I'm on assignment with Katie Greifeld, sitting in for Lisa. And John, we'll try to survive the next 3 hours with you. Quarter ending is where we are. And we're also on the $3 trillion watch. Sidebar, Apple, Tim Cook, Katie Greifeld, Apple approaches $3 trillion. Dan Ives at Wedbush has his eyes on $4 trillion.
And at the same time, I mean, we're getting headlines just now about Apple stepping up with the EU over antitrust charges. Of course, this dates back to sort of formal charges over its treatment of streaming music services such as Spotify. So we're approaching some big benchmarks here, but we know that Apple is sort of fighting on that antitrust
Well, they're
front.
in the news in Europe on the antitrust news, but the real answer is in the securities market. We'll all go to the data check in a moment, folks, and we're up again in the equity market. It's fractional or that. But the real story here, yes, we'll do crypto with Greifeld. Somebody, Bob just emailed in. Bob from the Hamptons says, do crypto. I said, okay, we'll do crypto later. But right now, we have to do the tech story of this equity market, which just continues to go and go. What did we learn about the semiconductor business yesterday that Lisa was so focused on?
Of course, it's the hot topic on a geopolitical scale, too. When you think about the U.S. and China hitting at Micron, it seems like the U.S. trying to protect NVIDIA market share when it comes to the U.S. So we'll see what happens on that front. But in the meantime, we know it's been a mega force in the markets, the NASDAQ 100. I think this is the best start to a year ever.
Since time began, like ever. And then, you know, we'll do some baseball here as well. Micron 67 off the announcements yesterday, up a solid $2 on MU, which really shows what they can do. I'm going to do a data check right now. They're going to get the Greifeld brief. Futures, as I say, up 9. Dow futures up 69. The VIX 13.62 has been, I'm going to call it range bound and quiescent, but that's a bull market statistic. In the yield space, much higher yields, a nice rebound here. And this bears some nuance here. We've got a higher yield with the 10-year to 3.75%. 2-10 spread reverts back to a negative 102 basis points. This is further curve inversion on the 2-10s spread. And the inflation statistic is truly at a tipping point. The real 10-year yield with a 1.58%. I'm really watching that tick by tick. I'll get the chance here. I'll do the technical work on that to see when that breakout is. Oil flat, 69.52 on American oil. The dollar survived for central bankers in Sintra. Really interesting conversation, I thought, as they squirmed and tried not to answer Ms. Eisen's questions here. Euro right now, 109.19. She pulled an all-nighter on the brief. Here's Katie Greifeld. What do you got?
Well, it'll be fun to see how that board changes at about 8:30 this morning when we have an absolute dump of data. We start with first quarter GDP. It's likely a little changed in the
third look
print. Yeah. So expecting more of the same. Below trend growth in the first quarter, about 1.4%. We also get initial jobless claims continuing to pick up, but just slightly. The number there expected is 265 versus 264 versus the last week. And then we also get pending home sales. Just interesting in light of that new home sales data that came in super hot earlier this week. Then we do have more Fed speak, not from Powell, but from Atlanta Fed President Raphael Bostic. He's going to be speaking in Ireland at the Irish Association of Investment Managers. He's going to be talking about the U.S. economic outlook. That's at about 3 p.m. I'm excited for this, Tom, because we heard from him on the 23rd. He said that he favors no more rate hikes.
Yeah, what's interesting, the tension here is really interesting, folks, in that every Fed is different. And this is Bostic, as a generalization, the dove here. And he says no more rate hikes. And yet his statistic is what everybody watches. The Atlanta GDP now number, which Mike McKee is suggesting with the economic data yesterday, may get above a 2% statistic.
And it's
So,
interesting, we get this,
there.
there's tension there, and we see that in their words, but then you think about the facts, no dissent at the last meeting, so do with that what you will. And then we finish the day with Nike reporting after the bell, and as always, of course, the focus is on guidance, what we're going to hear about business prospects in China, as well as their wholesale channels. Again, Nike reporting after the bell. It's actually down slightly, the stock, year to date in an up market.
Well, we'll have to see on that again. Futures up 9 as we start the day. Sort of a nudgy data check across equities, bonds, currencies, and commodities. What it is nearing the end of the quarter in every bank, every manager, every chief investment officer is recalibrating. We speak with Christian Nolting this morning of Deutsche Bank, their private bank. Christian, what's the key distinction here of your reset for July 1st?
Well, the reset is, I would say, probably we cannot, unfortunately, repeat the performance of the first 6 months and the second half of 2023. I wish. But the recalibration has to be, what are the earnings for second quarter? Are we entering a recession? And we probably cannot rule that out, given that the central banks, and you mentioned Sintra, are probably doing a bit more. However, then I think 2024 also in the second half comes into the discussion. And so it needs some, let's say, humble appreciation of the markets, if I would say.
If revenues are under challenge, if we get disinflation as tallied at Sintra, I believe the price effect of revenue growth comes in. Can units come to the rescue on a global basis? Can units save the day if we get disinflation at the top line?
Well, I wouldn't say we certainly go into disinflation already in the second half of this year. I think the environment we are in, and then of course we can look at the units, I think the environment we are in should be that we have sticky core inflation, and that has been reiterated, and I know central banks talk about this. And then if you think of growth on the other hand, even if there's a recession, I don't expect, and maybe that's not the nicest outlook, I don't expect a massive rebound upwards. So we are in an environment where we talk about the second half of relatively high core inflation, but still low growth. I wouldn't call it stagflation because the labor market is still quite decent, I would say. But it's an environment where central banks need to probably act more, and that's why we don't agree with so many cuts the market has priced in. And from that perspective, I think that's what you need to watch in the second half.
And Christian, as you look into the second half, what do you see as the biggest risk to markets? Is that going to come from inflation, like you mentioned, or is it an earnings story, or maybe geopolitics?
I think so. Geopolitics we have just seen over the last weekend, right? That can change very, very quickly. So that's something which will be with us for a very long period of time. I have lots of clients saying, well, this is a very risky environment, but if you look a little bit back in terms of decades, I would say we are just going to a so-called normal environment of lots of geopolitical risk being with us for quite some time. So we want and need to deal with that. That's number one, will be a topic for sure in the second half. But then secondly, earnings, I think, will be important. Sticky core inflation, which companies can live with this high inflation, which companies are price makers, which are price takers. So I think we move a little bit away from the macro side, really looking then on the company side, and can earnings surprise to the upside still, given that sticky inflation remains?
I want to stick on geopolitics specifically, because when you think about those risks, where do you expect those to be expressed? Is that an equity market story or commodities?
I would say it's honestly in all asset classes. First of all, yes, commodities, of course. But I think there's a lot of, let's say, still on the fiscal side to be done, no matter what geopolitical risk you see. So that will continue, and that could be even positive for the commodity story. I think you will see it in the equity market, but you also, I think, see it in the fixed income market. And think of the first half of this year where volatility in fixed income, which was much higher than in the equity market. So I think it really, there's not an asset class that can escape from this discussion, really.
There can be a reality that parachutes in, and moments ago, the New York Fed President, William Dudley, the former Fed President, writing for Bloomberg, parachuted in with a stunning essay. Christian Nolting, I'm so honored you're here to talk about where Dudley is on higher rates. Bill Dudley walks through the fiscal ballet in the United States, ignored at Sintra, and he says a conservative estimate for the 10-year yield out there somewhere is 4.5%. What does our investment world look like if we blow through 4% and take a U.S. 10-year yield, a German 10-year Bund, out to that 4.5 level?
Yeah, I think that's not priced in at this point in time. Look
I agree.
At the tech. That's good. Look at the tech side, right, which really lived the first half from, let's say, an environment where markets did not look so much, to be honest, at the sticky core inflation. We are more in that not 4.5, we are more in the 4 camp if you look at the 12 months forecast. And because if we get a recession, I think in 12 months that would be over, not a long one. And then you go back to growth. But as I said before, I don't expect growth to really shoot up. It's probably some low growth, so probably 1.2% for the US, maybe a bit less, 0.9, 1% for Europe. And that probably is an environment where yields don't go through the roof. So we are more in the 4% cap. But that's higher than right now, yeah, for sure.
I mean, the scenario here that no one's looking at is the one that Bill Dudley, and good morning, Dr. El-Arian, I think Mohammed's been way out front on this as well. But here's the key question, and this goes back, folks, to a guy named Irving Fisher a century ago. Christian Nolting, do we have a linkage here of the Dudley move to 4.5%, which gives us persistent higher inflation, or can we have that higher yield within disinflation?
I would say I don't see higher yield within disinflation, to be very honest. Yes, core inflation is sticky, but that's why I'm not talking really about disinflation at this point in time. Yes, we see that coming down in the headline, but the core remains sticky, so I'm not in this complete disinflationary camp. I think what we need to think of is we don't go back to this old, very low inflation environment. I think we are staying for quite some time, and here I talk not 12 months, but longer, maybe 3 to 5 years. We will stay above maybe the 2% level of the central banks. And that's, from my point of view, leads to the fact that they don't cut so quickly as the market is probably pricing. So we are more in the camp they stay higher for a certain period of time, because I think they don't want to be in error and say we cut, just to say, oh, inflation remains more sticky and then we need to hike again. I think that would be causing more volatility even on the fixed income market.
So the topic of higher for longer, I mean, the conversation we're still having about what the Fed is going to do really relates to how many more times they're going to hike and then how many times they're going to cut and how aggressively. I mean, should the conversation really be focused on how long they're going to stay at terminal?
I think it's important, right, to look at terminal rates. So they now mention the 5.6, so you can have a discussion on this. So I would say they really don't know at this point in time. They want to make it data dependent. I think they're really concerned, and that's true for many central banks now. Maybe Japan is different. We will see next month. But I think they will really want to avoid to cut and just to find out core inflation is more sticky, and we have all these issues coming with that one. And think about the strong labor market. So they are very strong. Lagarde talked about hoarding of labor, so which leads then to, again, higher core inflation. And from that perspective, I think that's where central banks would say, let's be data dependent, let's maybe do a pause as the Fed has done, then we do another hike, and then really let's wait with the cuts and don't be so quick with the cuts.
Christian Nolting, thank you so much, and particularly on the spur of it, commenting on the important Dudley essay. Mr. Nolting is with Deutsche Bank Private Bank. It's amazing you have a nudgy day like this, Katie, and it's sort of like we're walking in, and both you and I mean, we got to talk crypto later with Greifeld. That's how slow it is. Boom, there's the essay. And what's so important about this, folks, is Bill Dudley, who's been out front on a higher rate regime, he's been dead on, takes it even further today on the QE-QT debate.
And you add it all together, his analysis, and he writes that in sum, this suggests a 10-year Treasury note yield of 4.5%. There's a lot of daylight between where we are and that 4.5% number. It makes me more excited to talk to Matt Hornbach, who we'll be speaking to later of Morgan Stanley. He wrote recently he sees 10-year yields at 3.5%. At year end. So there's quite a debate going on.
There's quite a debate and a lot of different opinions, but this is the outlier call. Bring up that quote, please, again. I want to go through this. It's so important and really adjust the dialogue for Thursday morning launching into July. This is Bloomberg opinion, William Dudley, the former president of the New York Fed. Suppose the Fed's short-term interest rate target adjusted for inflation is 1% over the next decade. Inflation 2.5%. Do the math. Bond risk premium is 1 percentage point. In sum, this suggests a 10-year Treasury note yield of when Bitcoin didn't exist. It's from a few years ago. 4.5%, Bill Dudley. That leads the dialogue this morning from Bloomberg Opinion. Good morning.
analysis covering the biggest challenges facing the UK government, economy, financial services and markets.
Tax cuts should not be the priority. It's about a credible plan for growth over the next 2-3 years.
In this post-Brexit world, how do you see actually servicing your clients?
It was disruptive, and it's going to have implications to how capital raising works.
Now we're having the perfect storm in the UK.
Watch Francine Lacqua Thursdays at 9:30 a.m. only on Bloomberg, your global business authority. This June, in honor of Pride Month and Juneteenth, Bloomberg brings you a special equality series every Thursday in June at 1 p.m. Eastern. Bloomberg Equality, celebrating inclusion this Pride Month. The moment news breaks, no one covers the world like Bloomberg.
The image of Vladimir Putin as the all-powerful leader has been rattled already.
History was made here at the federal courthouse in Miami when Donald Trump became the first ever former president to ever be arraigned on federal charges.
We're going to need a new engine technology, and that's where the real battle lies. And whoever makes that decision first is going to have a huge impact on this industry.
Bloomberg, your global business authority.
Bringing down inflation remains one of my top priorities. Today, inflation is less than half of what it was a year ago. And that inflation caused by Russia and by the war in Ukraine and by what's going on. But we knew we had to do more.
The President of the United States trotting out the phrase, testing it yesterday, Bidenomics as well. Amory Horton, I thought was really, really bright on this yesterday. The White House trying to get a hold of the economic dialogue. All of this was pushed aside, and you know, I got to admit, sometimes I get up and I got a thing on the side of my face. Katie Greifeld in for Lisa Bramwitz and John Farrell. It says Bed Bath & Beyond right here.
Oh, yeah?
You know, the label is like glued to my face. Jenny Leonard and Jen Jacobs down in Washington with marks on the president's face, which had to do with sleep apnea and taking in oxygen, a medical procedure, a legitimate medical procedure. This has made a splash in the last hour with Bloomberg's reporting. And the answer is, once again, and it's not going away, we're talking about age. Not as old as the President of the United States. Gregory Valliere joins us now, Chief U.S. Policy Strategist at AGF. Greg, it's not going away, is it? And with the gaffes of the last couple days, plain and simple, it's not going away. Interpret, please.
Well, there's a lot of things working against him. I worry about a UPS strike in August that could last into the fall. I worry about a government shutdown. The student loan decision, maybe today from the Supreme Court, will go against him. And then you're right. There's the issue of age. And even though I think he's in pretty good shape, Trump is 77, the most telling poll result that I've seen is that a majority of Democrats would prefer that he not run.
Where does this play out through the summer? I get the idea that the Republicans are focused on a debate. I believe there's 42 people on stage. There's going to be a Republican debate in August, which is fine. But what's the timeline you perceive for a Democratic Party to get behind their incumbent president?
It's coming up pretty quickly, and the most momentum, and the momentum, Tom, that I've seen is for Robert F. Kennedy and Marianne Williamson, who were, in my opinion, fringe candidates. They have some momentum. Joe Biden does not have momentum.
What's interesting, Arcady, is the calendar here, and as Mr. Valliere with all of his acumen states, it just seems like everything's rushing forward, like July of 2023 is we're literally having an October of 2023 conversation.
And I mean, if you think about the November 2024 conversation, if you think about Bidenomics, a lot of the legislation that the Biden administration has pushed through, I mean, these are long-term investments, Greg. And when you think about the fact that it might not take, or it could take years for some of that to bear fruit, I mean, how does Biden necessarily run on that? Is it just a game of reminding and reminding and reminding?
You would think yes, Katie, but at the same time, I think if he keeps doing that, people are going to think that he's tone deaf, that he doesn't get it, because most Americans are still traumatized by inflation. Gasoline is still fairly high. Food prices are still fairly high. And when they hear Joe Biden saying things are a lot better, they don't get it.
And Greg, you've also written, though, that the Biden team has done a poor job of selling the economy's strength. So how do you sort of thread that needle if you're, campaigning Joe Biden? I mean, how do you sort of, point to the economy's strength, your accomplishments, without sounding tone deaf? How fine of a needle is that to thread?
It's really, really difficult. There's no easy answer to that question. I think they have to consistently say things are improving, but we're working harder to make things even better. But the risk here is that other stories are going to crowd this out. In particular, the IRS whistleblowers. I mean, you listen to their testimony, and it's credible.
Greg, I look at where we are, and I've been wrong, folks. I really haven't looked at the student loan debacle. The Supreme Court's going to rule on student loans. People are going to have to finally pay their student loans, right?
Right. It's a two-part story very quickly. Number one, the Supreme Court has to rule maybe today on the Biden plan itself, which probably will get thrown out. The other issue is loan payments, interest payments. They resume in October. I don't think anyone would contend that won't happen. So at least on that area, there will be a headwind for the overall economy. Some people say as much as $70 billion on an annual basis will get taken out of the economy because all of these students are going to have to start paying their loans again.
Help me with Capitol Hill now. I've had to stand corrected here in the last couple of days. I thought it was sort of a sleepy July. I'm wrong. There seems to be an unusual fervor for a July on Capitol Hill. Do I have that correct?
Yeah, yes, Tom. As I mentioned earlier, I think the whistleblower and the Hunter Biden stuff is going to stay strong. The other story that exploded in the last day or two is this fight between Kevin McCarthy and the Trump people. McCarthy said something I thought was maybe a little too strong about Trump not being a good candidate, and he got tremendous pushback from other Republicans.
Well, that's interesting to see, of course, Kevin McCarthy come out and sort of break with the ranks here. But, I mean, when you think about Trump's base, is that going to move the needle at all?
Well, it'll move the needle enough for him to win the nomination in all likelihood. There's an outside chance for DeSantis or even Glenn Youngkin. But no, I think that Trump is the nominee. The issue is the Democrats have somebody who can beat him. Right. And right now, the polls are starting to show in the last few days that Trump has moved into a slight lead against Biden.
Greg Valliere, thank you so much. Greatly appreciate it. With AGF Investments there, and his note today has a real complexity to it, where yesterday it was really focused on presidential messaging and what we should hear from President Biden. It's back, and I really can't say enough about this. I watched Padres Pirates last night, and the wonderful announcers from San Diego said they were going to hold the game in Pittsburgh because the rating was a 160 or a 165. But they said that if the air quality rating was 200, they would have canceled the baseball game last night in Pittsburgh. And the answer is, for those of you worldwide, this is Chicago, Detroit, Cleveland, rolling over into a really ugly morning in Pittsburgh, and then it drifts south below New York City. We really haven't been affected yet. And Katie Greifeld, the images from Washington this morning are stunning.
Stunning. I mean, it looks like New York. What was that, 2 weeks ago or so? And
yeah.
You bring up Chicago. I mean, Biden was speaking in Chicago yesterday, the old post office building. I mean, they had to sort of plan for that. Ultimately, they didn't cancel, but this is turning into a countrywide issue.
For those of you in radio, and Rob Carolyn has been wonderful about this, it's a 164 rating in Washington. That is Delhi, India-like. And my message here, in the amateur take I have, I'm like everybody else, I'm looking at the app on my iPhone. And the answer here is, this time around, to me, it seems worse. We just haven't had it descend on New York, in that we're getting ratings of 180, 200, and dare I say even 230, which is way above a Shanghai or a Delhi rating. But this is the Midwest of the United States. I believe it's been reported 17 states. And then it moves south to the Atlantic in Washington this morning. and you wonder if it's going to somehow move north and come up to New York. We're not there yet.
Maybe to ruin the weekend, though. Maybe that's the timing. In terms
Yeah, I think the timing is yeah, absolutely. That's an amazing image. For those of you on radio, it is truly a cloud of fog, if you will, a haze across the Washington Monument. It's 500 feet tall, and you certainly can't see the bottom of the Washington Monument this morning in the fog. What did you think of Sintra yesterday?
I thought it was interesting. You had, of course, the big central banker panel, BOJ, odd one out, but maybe hints of hawkishness that they could back off that monetary easing if they become confident in maintaining above 2%.
Mr. Ueda, the new guy in the block, and with his academics in America, it was a change from Kuroda with very little English to a very articulate governor of the Bank of Japan. Futures advance. That's because of Katie Greifeld. Futures up 13. Good morning.
For the first, call it 18 years at Chipotle, this was you come into Chipotle along the line, you interact with the crew, and you customize your meal. We've got this separate make line, and it's digitized, and so the orders come in, and they're really kind of staged so that if you say at noon, I want to come in at 1 o'clock, we hold that order, and we will send it to the crew like maybe 10 to 1,
Right.
so it's ready right when you pull up your car.
How do you manage these kind of two different staffing needs, right?
Yes.
And making sure you have the right amount of people
Yes.
at the right time.
We spend a lot of time projecting sales. A lot of it is, it's part art, part science. We're trying to bring more science and more AI into it. Because if you get the right sales projection, then you know exactly what your staffing needs to be. So if you get the sales right, you can get the entire restaurant staffed perfectly. With just a couple people, our average restaurant now does about over $1 million per restaurant in digital sales.
People ask me all the time, what is the key to being a really good investor? And I tell them it's to surround yourself with and work with the best investors you can find. On Bloomberg Wealth, I'm going to take you to meet the greatest investors in the world, the people that I would like to have managing my money.
Today, I would say perhaps only second to AI right now, which is AI has got so much going on that folks are so excited about it. Climate tech is the hottest area to be in.
Bloomberg surveillance on a Thursday claims here in 2 hours. Katie Greifeld in for Lisa Bramwitz and John Farrell. They're on assignment. I don't know what that's about. John's on a British assignment. Lisa's more on like a shorter American assignment. She's being more responsible. John is like touring islands.
Good for him.
Well, listen to you. Okay. Anyways, they're off, and Katie Greifeld pulled a short straw, and she is in. It is Thursday. Are you planning on a Tuesday crypto? Are you involved in staggering?
July 4th, so thankfully I won't be here. You might be here. I don't
Oh, that's
know.
the 4th, so there's no crypto next week?
No.
You're not shifting it?
No,
Okay.
thank goodness.
A 4th of July crypto, we can do that.
Yeah.
Futures advance up 13, Dow futures up 93. Yields are higher. There's a reset here. And as I mentioned earlier, one statistic I'm looking at, and this is before the Dudley bombshell that we had 15 minutes ago, is the 10-year real yield 1.57%. I'll find a hole here in the hours to triangulate the chart on that. The old inflation, the normal real yield is a 1.9, 1.90, 2.00, 2.03 maybe. We're way away from that, but nevertheless, we're grinding higher. And Katie Greifeld, that's the kind of inflation nudge, including the 10-year yield coming up, that Bill Dudley's writing about this morning.
And in terms of grinding higher, we know that in the first half of the year, obviously, the S&P 500 shot higher. And as we head into the second half, we have Marvin Lowe of State Street weighing in on recession risk as we head into the second half, writing, quote, recession betting has now taken center stage, will be a bigger driver of asset volatility than even inflation. We don't expect much resolution on the recession discussion over the summer. So choppy, range-bound trading is likely, in our view. A lot to look forward to.
A lot to look forward to, and it really sets up the template here that we've got this morning. We're going to start with central bank talk, next Sintra here, with Marvin Lowe. Mr. Lowe joins us in the studios from Boston, senior global macro strategist at Boston State Street. Wonderful to have you here.
It's great to be here.
It's a pandemic sign. We're over and we're through it. Let's frame, I love your note that Katie just read, and let's frame the lack of resolution here with the polarity of Bill Dudley with massive urgency out there on rates are going higher. And moments ago in Ireland, Mr. Bostic of Atlanta saying he doesn't see so much, he sees less urgency out there.
Yeah.
How do you collar the State Street strategy around those polarities?
You know, I mean, certainly I think it indicates, and obviously, Mr. Dudley is no longer on the Fed, but I think what you're seeing there is what's playing out in the Fed. I don't buy that there was a unanimous decision. It was constructed, particularly given where the estimates were and kind of where the dots went. But I think you have that broad of a view amongst the committee. And on the one side, if you're thinking 4.5% 10-year, you're thinking the Fed's not going to be successful in reining it in. I think the doves, those who I guess got their say in skipping, are saying that there are things out there. Whether it's student loans, whether it's credit loan deterioration, whether it's just kind of the broad slowing of the economy, that's going to start to finally have an impact in the next 6 to 12 months.
I want to talk about the fact that it was a unanimous decision, and then you look at the Fed speak that we're getting, and there's a clear gulf there. Why haven't there been any dissents? Do you expect to see some dissents among this FOMC?
We get the minutes soon. Love to see what they say there. I don't buy that there was no dissents. There's no. It was constructed. I think they did themselves a disservice by kind of putting out that message, because it really does feel like they're just managing the process. I don't know if we want a central bank to manage this process at this point, but certainly this Fed has spent a lot of time trying to make the message unanimous, and in this instance, I don't think they got done what they would have hoped from that perspective.
Mm-hmm. And putting this on a global scale, I mean, it's been remarkable just how lockstep some of these developed market central banks have been. I remember the conversations I was having at the start of the year was that maybe we see the ECB, the Fed, the BOE maybe break apart. It doesn't seem like that dynamic is necessarily going to change.
Yeah, I mean, not yet, right? Inflation is still, even though we've gotten some surprises to the downside. I can't remember the last time we said that for more than just one reading. But that inflation, that sticky inflation, is still the main concern. So it's easy to kind of march to the same drummer, but we're definitely going to get that divergence, because you've got economies that have very different dynamics kind of coming out of this.
What is the asset allocation then, given a messy summer with no resolution? I mean, if you have to look out 6 months, and dare I say with a State Street responsibility, look out 3 years, how do you allocate? I mean, in honor of the late, the Nobel laureate Markowitz, who died here this week, do you just go vanilla 60-40, widely diversified, or can you be more creative?
Yeah, so you know, we take a lot of clues from our institutional investor readings, and our indicators show that there's a continued defensiveness around that. So there is a build of cash allocations. It's getting above longer-term averages. So this recession concern is still out there. And then within that slice, you know, we do see a pullback within cyclicals. We do see a pullback within commodity-type allocations, and I think that that's where you start playing around the nuances. Quality growth, getting potentially into healthcare, things that are going to respond to that recession. And again, those institutional investors that we look to for guidance are doing that, and they have been doing that since the beginning of the year.
This is really important because I get massive cross currents on the show here on the appetite of institutions to participate. You're telling me there's a cash build out there right now? Are they under-owned in Apple?
Couldn't really speak to individual companies that way.
Thank you.
But
yes,
from
I know. Yes. Good morning, compliance from State Street. Good to see you.
You've done this a while.
Yeah.
But we are seeing that we are seeing that allocation come out of riskier parts of the market. Equity, overall equity exposure has come down. Cash has come up, and there is fairly strong demand for the kind of that sovereign bond type of hedge.
So that sounds like how you develop a second leg of a bull market. If you believe off the October low, you got to have some form of pessimism out there to surprise people to a second leg of a bull market. Do you want to participate in equities thinking that a bull market of some slope will continue?
I think that I want to make my equity exposure make sense in terms of where I see the world coming. You know, there's this very bifurcated world where, you know, we either own all of this or we don't own any of it. You know, that's not modern investing. You know, we really don't have that ability. But make sure your portfolio reflects the recession risk that you either have or don't have.
Should we talk about artificial intelligence? Because you think about where the world's going, a lot of people would say that AI is going to be a big chunk of it. And when you're thinking about sort of recession-proofing a portfolio, what role does big tech play? Because for a lot of people, that's turned into a haven asset.
Yeah, I mean, certainly quality growth. If you know, I've thought about these balance sheets from the perspective of, if I like cash at these levels, what companies have cash and what companies can actually take advantage of that cash number. And it is big tech. You know, they have a lot of ability to manage their balance sheet the way other companies can't. And I think that does give them an advantage. Particularly, you know, there is a lot of discussion about whether or not stagflation or maybe a slower growth environment emerges where inflation doesn't necessarily go back to what we had before the pandemic. Who can take advantage of that? And if you are talking about maybe higher rates than what we saw back in 2018, 2019, you get paid for that cash on those balance sheets. So yeah, you know, I do think it becomes much more nuanced as we come out of the pandemic and as we come through this inflation discussion to really find companies that are thriving in that type of world.
I'm really glad you're here because something I've been noodling on is sort of comparing treasuries as that ballast of the portfolio to mega cap tech. And I know you can't speak to specific names, but when you think about an Apple, an Amazon, is that just as good as holding, you know, a 10-year treasury?
You know, I wouldn't say that. You know, ultimately, I have full faith in the U.S. government, despite the fact that we went through what we did over the course of the last couple of months. And there is kind of a more global demand for that type of asset. Having said that, quality growth is something that is a core part of a portfolio, I believe.
If you're a New York guy like Marvin Lowe, maybe this would be a good time to cut in and talk baseball. You're up in Boston. Nobody wants to talk the Red Sox. For our international audience, something happened magical on a summer's evening last night in America. In baseball, this is for our cricket audience that doesn't get baseball, like I don't get cricket. There are 27 outs, 9 innings and 3 outs. And the basic idea here is there's no walks, there's no pass pitch, there's no audibles, there's no variables. Vermont got 27 people out in a row.
It was a perfect game.
Years in my life, this is a rare deal, to say the least.
I didn't see that.
24th ever.
We can count
The dreaded New York Yankees had a perfect game last night.
That is incredible.
Yeah, this is really, I really can't say enough how unusual this is, folks. It's the 24th in history, but Katie, this is like once every 10 years if you're lucky.
I heavily researched this in preparation for this show. The last one happened in 2012, but the question that I have is they were playing the A's, I understand is a very bad team. I hope that that's not controversial to say. Is this,
I'd like to say good morning to our San Francisco and Oakland audience. Greifeld burying it right now.
They're still asleep, I hope. But is this the case of the Yankees, really crushing it, or just the A's being bad?
It's both, but it's also rude as all get out when somebody has a no-hitter, which is nothing like a perfect game, to say, well, the other team was weak, or however you want to phrase it. And the answer is the A's are a professional team that shows up. I might point out they beat the Yankees the night before.
That's true.
But yeah, they are one of the weaker teams. A perfect game right now against the Texas Rangers and Atlanta Braves would be a different story. You could equate the Oakland
I'm just going off
A's
the forums
with
and
the
stuff that I ended up on.
With the Boston Red Sox. I'm doing this because Bramwell would just, Bramwell's actually pretty good at this. Farrell would be looking at the ceiling. Why are we not talking about the 10-year real yield? But this is really, really something to see the latest. I look at this, and it is the dog days of the summer as witness baseball starting to heat up and all that. How do you stay focused at State Street on the mission of getting to the fall and, frankly, getting into 2024?
Well, we're professionals. We've been doing this for a while, obviously.
You don't take the summer off.
We don't take the summer off.
This is the smartest observation this week. Bottle this, guys, for a commercial. We don't take the summer off, do we?
There's going to be a lot of things to sort through. We're data dependent. We are seeing individual data points that normally don't move the market. So you're going to have that choppiness, and we're really going to need to figure out if this very long-awaited recession continues to be an overdone, overhyped story out there, or whether or not we're finally going to start to see that growth slow down more broadly than we have.
And that focus on every single data point, is that just summer conditions? We need something to talk about? Or did Powell really set us up for that? When you think about, every meeting is a live meeting, July is a live meeting.
A little bit of both, for sure. After we get through July, we don't have anything until September. So, we are looking for those data points. Kind of having said that, we're at that point in the cycle. Again, just the difference in opinions on the FOMC shows that certain people are going to be looking at data points one way. The other group is going to be looking for other data points, and that ultimately requires us to look at those data points.
Marvin Lowe, thank you so much for joining us from State Street this morning on staying focused to Labor Day, which sometimes can be a challenge. I believe you got the chart up. This chart on radio looks great, and it is what we have seen in the inflation-adjusted yield. This was all the rage. Of course, John Farrell, with his wonderful ownership of the real yield, this is the real yield. We take the benchmark 10-year maturity, the doldrums of the pandemic where they're absolutely crushed yield, and then up we go. And Katie Greifeld, we're really buttressed right now to 1.57%, and that Dudley-like breakout, the shock you could get there, I'm not sure people are anticipating that.
And it looks like we're a little range-bound there, but you think about that fantastic move from negative 1% all the way to a full 1.5%. That is crushed returns when you think about tips. It's been really hard to hedge inflation.
Surveillance correction. It's during a surveillance nap, so I usually don't see it. Real yield. Bloomberg, the real yield. It's hosted by one Catherine Greifeld.
Sitting right here.
Futures up 14. Dow futures up 100. Boy, am I in the Greifeld timeout chair. Good morning, I think.
The EU is one of the largest and wealthiest consumer markets in the world, and there are very few global companies that can afford not to trade in the EU. So as the price for accessing the European market, these companies need to obey European regulations. That's not surprising. But often these companies choose that they will extend the European standards across their global conduct and their global production because they want to avoid the cost of complying with multiple different regulatory regimes. So there are benefits to standardization, benefits to uniform production. So all the EU needs to do is to regulate the single market. And it's then the market forces and the business incentives of global companies that transform that EU rule.
Business Week Radio, live weekday afternoons at 3 p.m. Eastern.
We got a little bit of talking.
Are you guys ready?
Harnessing the power of Bloomberg Business Week, Carol Messer and Tim Stanovic bring you the latest news from the worlds of business, technology, politics, and more.
How does the Fed play into this and what the Fed does potentially?
This is so exhausting and this is so all-encompassing.
Listen on Bloomberg Radio and streaming on YouTube and Bloomberg Originals.
As noted in the FOMC's Summary of Economic Projections, a strong majority of committee participants expect that it will be appropriate to raise interest rates 2 or more times by the end of this year.
The chairman, not on the panel yesterday with the governor, and the president, Chairman Powell there, commenting on lift up. He was in Madrid to do that. Madrid is in a different country from Sintra. I learned that yesterday. Sintra, Portugal, really lovely. Francine Lacroix with just really wonderful reporting from this important confab. Very different than Jackson Hole. We will be at Jackson Hole, looking forward to that. But there's Chairman Powell advocating forward. If you're just joining us, with a lift to the market, futures up 14, maybe off the semiconductor news. Katie, is it generally the news yesterday on semiconductor frenzy was positive, right?
It was interesting. I mean, initially you saw the likes of NVIDIA, AMD drop on those headlines that, you know, the U.S. could reportedly tighten chip exports,
Yeah,
but
but
then
on earnings,
it
it
came
was
back.
like, OMG, your earnings were pretty good, right?
Yeah, and
They
then
came
earnings
back.
came in, Micron. You
Yeah.
saw that bad sentiment dissolve throughout the day, and then Micron really drove it home.
Joining us this morning with John Farrell on assignment, Lisa Abramowitz on assignment, Catherine Greifeld joins us. Of course, look for her in the crypto. Kieran from Sydney, thank you so much for emailing in the evening of Sydney and suggesting crypto is a Thursday date here for Katie Greifeld.
Just next week. Usually it's on Tuesdays with the holiday.
It's a one week thing.
Yeah.
That's good. Well, we got green to the market. You're bringing good news here, Katie. Yields higher. We're watching the 10-year. We'll mention that through the day. Oil 69, 66 on West Texas Intermediate. This is a really good story. Bloomberg reporting here. Thank you, Jan Patrick Barnett and the rest of our team in European banking. And this is an American story about European banking. If you're new to the game, UBS is rolling up the last of the 3 Swiss banks. There will be one Swiss bank. Credit Suisse is melding in some cosmic way into UBS. And they do this with, with all due respect, an American chairman. His name is Colm Kelleher. And boy, did you see his footprint on the merger in the last 24 hours. Reporting Shonali Basak, our Bloomberg, get the most boring guy at Morgan Stanley correspondent. Who is this guy? Mr. WIPF, W-I-P-F. And we don't hear from him because he's not a slick investment banker, is he?
But not boring at all. As you know, the reason he's so well known is not Morgan Stanley, it's his Grateful Dead cover band. And so what's interesting here about his move over to Credit Suisse, Colm Kelleher, the chairman of Credit Suisse, is known on Wall Street, known at Morgan Stanley for having one of the most loyal bases of people who have worked for him. That is something he's always understood. Now, to bring over Tom WIPF from Morgan Stanley after almost 4 decades to help lead this transition, remember the complications here is not just a matter of bringing 2 behemoth banks together, but making all the businesses work together. Something Morgan Stanley was able to do very early on was make the wealth management work with the investment bank. bank and make the investment bank work for the wealth manager. That is something that UBS and Credit Suisse have been trying to work forever.
And what's so important to me is Whip had the worst job at Morgan Stanley. I mean this with immense respect, folks. He's the LIBOR guy. And more than anybody on the street, he's the guy who said the benchmark calculation, think Mary Poppins, their railways to India, the LIBOR funding of everything out there, we're going to stop doing it and we're going to have a new thing, which only Ira Jersey understands. And the answer is, am I correct? Whip is the guy that led the charge on the migration. I mean, what a boring job. And that's what he's got to do at UBS.
Boring but important and interesting. He was on the Alternative Reference Rates Committee, ARCC, and the committee appointed somebody else from Citigroup to lead that committee as well. So on Wall Street, he was important for the LIBOR transition. More than that, he has such a strong fixed income background for this reason as well. And remember, post-crisis, UBS really changed. The base here of fixed income expertise at Credit Suisse and UBS are very, very different. The risk tolerance is night and day. And so there are some very difficult decisions to be made about how the combined businesses operate moving forward.
So he's got Grateful Dead, he's got the LIBOR transition under his belt. Let's talk about what he's been tasked to do with UBS. Just going off the story, he's going to lead the bank's effort to integrate Credit Suisse's operations in the Americas. When you think about that task versus what's going on in Europe, how does it compare?
Listen, something that was interesting, people ask a lot about Credit Suisse, what was left of the investment bank, and the reality is quite a lot. They have a big leveraged loan operation. They still had a big trading operation, but it was kind of messy. Remember, there was very many hiccups leading into the end there. And so the Americas as well, part of this, remember, I think that the talent story cannot be denied here. They're in the process of cutting a lot of jobs, figuring out the overlap. Clearly, they're bringing people on, the people that they need to kind of make this all work for them. And remember, UBS in particular, they have a massive, massive, massive wealth management operation. There are financial advisors across the United States, and there's plenty of investment bankers in the U.S. for both banks. So it is a large operation in the United States with a lot of concerns about how they bring together, like I was saying, those cultural differences and the risk tolerance of these banks.
Well, broadly speaking, let's talk about that timeline, because as you mentioned, they are obviously axing a lot of the Credit Suisse workforce. The big news out earlier this week is that reportedly UBS preparing to cut over half of the Credit Suisse workforce. We know that they're also bringing people on. Is that the next phase? Should we be expecting more headlines to the effect of who is actually going to get this job done?
Yeah, and even just in the near term here, the way that UBS is operating is it's kind of a parent company to these two separate banking divisions, Credit Suisse and UBS. At the end of August, we'll see the consolidated financial results. It's already making me kind of nauseous to think about what that will look like. And so, yes, it's a very complicated integration, but both of these folks, both Tom and Colm Kelleher, have seen difficult days before in banking.
Where do you perceive UBS/Credit Suisse will end up in New York City? I mean, Katie brings up the geography of this. Let's forget about London, forget about Zurich. I got to believe they're going to maintain Zurich to some extent because of the politics. They don't have the politics in New York, do they?
Well, there's politics in banking everywhere.
No, but I mean, they don't have to talk to Mayor Adams about it. It's not, Zurich is different. What is this going to look like in 24 months in Manhattan?
That's a great question because remember, I think about this a lot because Credit Suisse was in that iconic Madison Avenue building, 11 Madison. And, you start to have bankers across the street, really, just maybe 10 or so blocks away over at UBS on 6th Avenue, different culture over there. It's starting to move over. I even wonder what's going to happen to that lease over in the Credit Suisse building. And so, yes, I mean, they have a massive New York presence. And remember, for both companies, Credit Suisse does not have a large wealth manager in the United States. To be clear, UBS does, but they do have a large investment bank in the United States.
What's important here, and we're talking to Greifeld and Bassick here. I mean, they're looking out at the Hamptons at the lobster roll. But, I mean, this guy Whip, this is a serious deadhead band. I mean, hell or high water, they actually play. The guy with the blue T-shirt on looks like Jerry Garcia. I mean, he's got the look down cold. And if we got nothing to do, July 3rd, Rockaway Point, the Sugar Bowl,
There
They're
you go.
playing. I mean, Shonali, this is Bloomberg reporting. I think, Redo, what do you think, folks? Redo, keeper of the Amex? You just run it up
to be
there.
very honest with you, I did want to write a story about his cover band. I just never got to it.
Here's the perfect news pad.
You can report July 3rd on this new guy who's going to save UBS and Credit Suisse.
But the last time you got me to write about the piano bar at Davos, I got in trouble for it. So
Everyone who writes, this is a cardinal rule, everyone who writes about the piano bar does get in trouble. This is a fact of life. This is, to me, a huge announcement. And again, the imprint here of Colm Kelleher is extraordinary.
the kind of Morgan Stanley UBS mirroring has always been a big question. I remember a UBS banker once telling me that they were afraid that Morgan Stanley would one day buy Credit Suisse. He said it kept him up at night. And I remember when I was reporting, I covered both banks for maybe almost 10 years now. Colm would be seen having a drink with clients at the Somme Wine Bar, which is right behind UBS, while he was at Morgan Stanley. So, there's a very close tie between all these businesses. Morgan Stanley was the behemoth, but it can't be discounted that Colm has a tremendous amount of relationships, not only among the banking ranks, but also among wealth management and wealth clients.
20 seconds. We're into the weekend. The summer begins. How grim is it out there on Wall Street, Manhattan?
The idea that UBS Credit Suisse will be cutting that many tens of thousands of jobs at the same time as Goldman and JP Morgan and Citigroup are doing multiple rounds of layoffs is grim. There is very little capacity to bring on new bankers on Wall Street.
Great reporting by Alexandra Harris at Bloomberg here. Mr. Whip, I hope I'm pronouncing that right. He's going to have a getaway, not an Alabama getaway. He's going to have a Zurich getaway to help UBS bring in Credit Suisse. We've got much more coming up. We do it with a market that has a lift to it. I really can't emphasize that enough. Futures up, equality 13, 44.31 on SPX futures. Stay with us.
Our studios in New York and San Francisco. Our expert hosts have the data and analysis about the companies you know and the startups to watch. Plus, the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West. Only on Bloomberg Television, your global business authority.
Keeping the faith in billionaire Warren Buffett. The legendary investor turns 93 this August. His signature must-read letters to shareholders have been getting shorter and shorter. This year's letter contained few fresh ideas. But most investors in a Bloomberg survey say Buffett's steady Eddie approach of buying cheap, safe, high-quality companies will beat the market. They expect returns in his investment company, Berkshire Hathaway, to outperform the S&P 500 over the next 5 years, adding to an incredible run in which Berkshire shares have returned more than 3,000,000% in the almost 6 decades Buffett has led the firm. Investors are also willing to pay up for Berkshire, which owns everything from the railroad BNSF and car insurer Geico to See's Candies and Coca-Cola. About 1/5 quantify the Buffett premium at more than 10% of Berkshire's stock price. More than a quarter say it's somewhere between 5 to 10%. There is one problem for Berkshire Hathaway, its size. Thanks to a bunch of cash-generating insurance companies, Berkshire has at least $130 billion in cash that it can put to work. But it needs big acquisitions to move the needle. Buffett calls it hunting for elephants. And we know Buffett hates overpaying. So that means sitting tight, patiently waiting for the right moment to pounce on the right company, which might be a drag on performance for now, but as Buffett fans know, usually works out in the long run.
Lots happening on Wall Street.
There are so many factors at play today.
It remains tight in certain parts of the economy.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insight.
Crisis is too strong a word, and words like that get used a lot.
From businesses most influential and instrumental.
America's economy needs a diversity of institutions. That's something that Wall Street pays a lot of attention to.
Bloomberg Wall Street Week, live Friday with replays all weekend on Bloomberg Television and Radio. Markets countdown in Europe. From the financial centers of the world, Bloomberg Markets European Close with Guy Johnson in London and Alex Steele in New York. Real-time numbers, real-time analysis. Weekdays. From the world of politics to the world of business, Every weekday at 5 p.m. Eastern Time, hosts Anne-Marie Hordern and Joe Matthew alongside Kaylee Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power, every weekday at 5 p.m. Eastern Time, only on Bloomberg, your global business authority.
Although policy is restrictive, it may not be restrictive enough, and it has not been restrictive for long enough.
We have to be as persistent as inflation is persistent.
It is a worse outcome if we don't get inflation back to target.
We believe there's more restriction coming. I wouldn't take, moving at consecutive meetings off the table at all.
We have covered a lot of ground, and we still have ground to cover.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Good morning, everyone. Jonathan Farrow, Lisa Abramowitz, and Tom Keene on radio and television. It's a Thursday. We're staggering into the third quarter of 2023. Farrow toughing it out. He's on assignment. Bramo toughing it out. She's on assignment. We dragged her from the afternoons. Katie Greifeld. You were at Haverford. I mean, nobody at Haverford gets up before 10 a.m. Is this the first time you've been up this early in years?
Woke up at 3:30 in the morning this morning.
Yeah, normal.
I actually woke up at 2 and then stayed awake for a while. So
welcome to my world.
Yeah.
Yeah. It's called the surveillance nap. I don't care how old you are. The surveillance nap. Ken Pruitt, the late great Ken Pruitt, taught me. He said, "Shut up and take a nap every day," which I do, and it's beneficial to this crazy schedule. Our schedule is that we're thrilled you're with us worldwide. We're going to go through the bombshell right now, push everything aside, and have you consider a different future out there. And it is courtesy of William Dudley of Berkeley, of course, the former president of the New York Fed, and he writes a blistering essay this morning. I wish they had this. It's Sintra yesterday. Dudley makes it simple. The math is a 4.5% 10-year yield. Suppose the Fed's short-term interest rate target, adjusted for inflation, averages 1. Add in another 2.5. And the bond risk premium, thank you, Frank Fabosi, is 1 percentage point. In sum, added up, this suggests a 10-year Treasury note yield of 4.5%. Katie Greifeld, how many people out there are ready for a 4.5% 10-year?
I mean, a lot of the notes and the conversations I've been having are saying extend duration. So definitely an outlier view. Excited to get into that with Elise Ozenbach in just a moment. But let's go through the brief really quickly, because in about 90 minutes, we're going to get a lot of data, starting with first quarter GDP. It's the third print, so more of the same, expected to show below trend growth in the first quarter, about 1.4%. We also get initial jobless claims continuing to pick up, and pending home sales all coming at 8:30. Later on in the day, we're going to hear from Atlanta Fed President Raphael Bostic. He's speaking at the Irish Association of Investment Managers on the U.S. economic outlook. Will be interesting to hear his updated thoughts on basically what this Fed should do with the remainder of 2023. And then finally, after the bell, we do get Nike earnings. Retail has been really interesting this reporting season, and Nike is no exception. The stock is down this year about 3% in an up market. It's going to be interesting to hear management commentary on China.
Do you think the movie helped him? I mean, are they going to come out and say that the Air Jordan movie helped him? Did you see it? It was outstanding.
We'll see if they get a question
really
on that. I'm curious to hear how they bring up AI. Everyone's bringing up AI.
Come on, Nike. What does AI have to do with moving sneakers?
I don't know, but Kroger brought it up 8 times in their earnings report.
Yeah, it has a lot to do with moving avocados as well. Let me do the data check here. We look at equities, bonds, currencies, commodities, and again, we've got an equity lift this morning. I'm going to give you the levels right now. 4430 on SPX is a shock to say the least. 34,000 nicely on Dow, and 15,000 on NASDAQ 100. And on the Apple Watch, Amy, I don't know if you've got the Apple banner there. You can read it out for radio, but we are on a $3 trillion watch on a market cap of Apple. Dan Ives at Wedbush modeling out $4 trillion out there somewhere, but that'll be worth seeing. seeing. Our Dan Tillis does the math and comes up with $190+ per share is where we need to be on Apple for that magic moment. Yields higher. I really want to emphasize 2-cent spread. It comes back to that big inversion, negative 101 basis points. And the real yield, 1.57%. You're going to hear me talk about this a lot in July. Currency markets give me no love. Maybe they're calming down after Sintra and all that. Sterling 126.52. And again on oil, which we just have, it snuck up on us, 69.84 on oil. We welcome all of you to the reset of June 30. I believe it's tomorrow. You're right,
That is, it is the 29th.
We're there. Elise Ossenbaugh joins us right now, investment strategist at JP Morgan Global Wealth Management. I love your note because it's for all the people out there, and you know who you are, that don't own Apple. And what you're talking about in your note is you have to rebuild an equity portfolio. How do you reconstruct equities after I'm up 2% for the first half, and that's not good enough?
That's right. We are very focused on encouraging investors to start rebuilding the equity exposure that they want to carry with them through the next cycle. And big reason for that is that when we look at our anonymized kind of aggregate client data, it shows us that half of our clients own less equities than they did a year ago. So right now, rather than focusing on broad index valuations, which are above their long-term averages, we're looking for those pockets of value. And it's encouraging that if you strip out the 7 biggest names, you actually find that the rest of the S&P 500 is trading below its 10-year forward-looking price to earnings multiple.
This is important, folks. I mean, Marvin Lowe in from State Street, which is a different remit than JP Morgan Global Wealth Management, but you've both got the same message, and that people really aren't participating. They're in cash, they're cautious, they're nervous. Is buying a consumer like General Mills up 9% dividend increase yesterday, or Procter & Gamble, or name other things we never talk about on this show, you've got to hold people's hands for them to buy 422 shares odd lot of Procter & Gamble?
To some extent, right? But we are focused on different opportunities, certainly within the active management space, but also things like the overall composition of their allocation. We do think that leadership in this next cycle is going to look different than it did in the last. We're more focused on some real economy sectors, but complementing those exposures with these innovations that are kind of bubbling up, like artificial intelligence, of course, and really looking for value right now. And we're seeing that in other areas beyond just large cap equities. Think US mid caps, think international equities, although our views there are shifting somewhat, and also complementing that equity risk exposure with a core bond duration position.
I want to get to the leadership of the next cycle, but I want to start with that call that basically you're helping investors rebuild their equity positions. Really interesting because coming into 2023, this was billed as the year of the bond. Fixed income actually has income attached. And now, midway through the year, it feels like it's kind of turned into a game of catch-up where those investors who had bought into the year of the bond are now trying to catch up to that equity rally.
Yeah, and for us, this call is not about trying to chase a rally. It's really about remembering what it is we hire stocks to do in a portfolio in the first place, and that's to be the engines of long-term capital appreciation. If we zoom back out, I think this cool down in volatility that we have seen is giving us an opportunity to kind of reassess and move forward with cooler heads. So when I go back and think about something like our long-term capital market assumptions, which suggests that over the course of the next 10 to 15 years, you're still going to be able to annualize total returns of 7.5% to 10% in equities. It's like, why not now, especially when there is value to be found in the market?
This is why we love having Elise on. Short term is 10 to 15 years. It's a different outlook.
Got it. Well, let's talk about the leadership of the next 10 to 15 years of this next cycle. You mentioned it's not going to be the previous leaders, which is big cap tech. But when you think about some of those smaller companies, those mid-sized companies, what's going to be the AI moment for those companies? You think about what's powered.
You guys in AI. All these kids in their AI.
It's the zeitgeist.
Here's my AI. I got a Hewlett-Packard computer on my iPhone.
Yeah.
Continue zeitgeist.
Yeah. Well, in any case, I mean, you think about, you can make a lot of arguments about valuations on the FANGs, et cetera, but still it feels like almost we had a reset when you think about, again, that AI moment.
Indeed. And I think that leadership and kind of that theme will trickle down into some of those smaller cap companies where we're focused on the mid-cap space rather than small caps because we do see a better valuation there. But looking forward towards the next cycle, I think we have to remember that playing AI doesn't just require picking out the enablers of it, but really thinking through some of the cross-sector applications, whether that be, you know, establishing factors of the future or rethinking supply chains. So you've got to kind of expand your purview and think about all of the different types of disruption that this could potentially pose.
Bear it in your note, there's way too much X this and X that, but X this and X that. Where JP Morgan comes up with is if you take this out, take that out, take stupid AI out, take Bitcoin out and the rest, the market's trading at a 14.8 multiple. 112% of our audience doesn't agree with that statement. Give me an example of a sector group that's trading at a shocking multiple from 20 years ago.
At a relative discount, you mean?
Yeah.
I mean, for us, that's mid-caps.
That's Northwestern talk. I'm just talking cheap. She's talking relative discount. Continue.
Sure. So mid-caps is a perfect example of that for us. You can play a lot of the same themes that investors are getting very excited about, but rather than fish in this overvalued pond, look at an area of the market that is more fairly valued.
So like in retail, Walmart's ridiculous. I'm sorry. I look at the single-digit revenue growth of Walmart and I go to get it. You're looking at, you know, as a generalization, a given Walmart and mid-cap.
Sure. I'm not supposed to talk about single stocks here
No, I know
on
that.
television.
Well,
but
I'm just trying to
yes.
get you in trouble with compliance.
Yeah,
you know.
yeah. You're getting at the right idea.
Yeah, I'm getting at the right idea. I'm going downhill so fast. Why did I get out of bed?
0 for 2 so
Save
far.
me, Catherine. Give me some help here.
Let's talk quickly about duration, because you also write that now is the time to extend duration. Bill Dudley coming out on the other side of that trade this morning with a great column. Why is now the time?
Look, I know Powell and other central bankers are talking very hawkishly. That was certainly the case yesterday. But our base case is still that the Fed probably only has one more interest rate hike in their pocket. So assuming that, if you get a policy rate that's, let's call it 5.3%, our model suggests that the fair value for the 10-year yield is about 3.8. Not a big stretch from where we're trading today, but if the Fed should hike, you know, additionally beyond that, for every 25 basis point hike, that's an additional 15 basis points of yield on the 10-year. So we don't think that right now the entry point is looking too crazy, and our base case is that 1 year, 2 year, 3 years from now, those yields are going to be lower. And so we want to move into that, not just for the opportunity to lock in those elevated yields, but also from the portfolio construction perspective.
I'm busting your chops, but this is really, really valuable. This is the heart of the matter, folks. You don't own Apple. You don't own NVIDIA. What do you got to do? You got to rebuild. It's perfect language. Rebuild, reconstruct a portfolio, and it takes courage to do that. That was very nice. Elise Ossenbaum, thank you so much.
Thank you.
With JP Morgan Global Wealth Management today. We have a lift in the equity markets. It's perfect. The Standard & Poor's 500 up 0.3%. And we say good morning to you. Katie Greifeld in for Lisa Bramwitz and John Farrell. They are on assignment. We're on assignment too, to inform our international audience, and particularly those waking up across a large 17-state area. It's going to be a difficult weekend. It's been a difficult couple days. I've seen some shots, I think, of Pittsburgh earlier that was extraordinary. Thank you for the emails in, particularly from our Canadian viewers on BNN. The idea here that what's different this year is the fires are usually out west. And Katie, they're in Quebec, in Ontario, northern Ontario, coming down through Chicago. And this morning on the East Coast, it's really odd because New York's pretty good. Boston's wonderful. And Washington is not. For those of you on radio, the imagery of the Washington Monument, 550 feet high, just shrouded in smoke. There's no other way to put it. It's difficult in Washington this morning.
You know, I'm actually going to Canada next week. We're going to Quebec, so I'm interested to see what the scene is there. But to your point that these fires are usually in the West, it explains in a big way why I think 2 or 3 weeks ago when we had that smoke in New York, everyone was surprised. People were fumbling for their masks again, didn't really know how to handle it.
My memory on this, folks, is Philadelphia was actually worse than New York last time. And this time around, the selected cities of the Midwest that have been hammered, Chicago, Detroit, and others, were on the edge of Philadelphia or even worse this time. And there's a real mystery here this morning. Be careful out there if you're flying, and certainly if you're in some of these pockets, and clearly one of the pockets this morning is a nation's capital. We greet you on a Thursday. Claims coming up at 8:30. I believe Michael McKee is not on assignment this morning. He will be with us in the 8 o'clock hour. Anticipated Matthew Hornbach of Morgan Stanley. On radio and television, this is Bloomberg Surveillance.
London and Sydney.
From Washington.
In Tokyo.
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening.
Here's what I'm watching.
You do not want to miss this
Is
story.
there the kind of upside?
Bloomberg UK, your source for news and analysis covering the biggest challenges facing the UK government, economy, financial services, and markets.
Tax cuts should not be the priority. It's about a credible plan for growth over the next 2-3 years.
In this post-Brexit world, how do you see actually servicing your clients?
It was disruptive, and it's going to have implications to how capital raising works.
Now we're having the perfect storm in the UK.
Watch Francine Lacqua Thursdays at 9:30 a.m. only on Bloomberg, your global business authority.
On the David Rubenstein Show, peer-to-peer conversations, I uncover the untold stories of the world's most successful leaders. Watch Wednesdays on Bloomberg Television.
The moment news breaks, no one covers the world like Bloomberg.
The image of Vladimir Putin as the all-powerful leader has been rattled already.
History was made here at the federal courthouse in Miami when Donald Trump became the first ever former president to ever be arraigned on federal charges.
We're going to need a new engine technology, and that's where the real battle lies. And whoever makes that decision first is going to have a huge impact on this industry.
Bloomberg, your global business authority.
Under trickle-down economics, it didn't matter whether you made things as long as you helped the company's bottom line. Even if that meant seeing jobs and industries go overseas for cheaper labor. Supply chains and key products moved overseas, like China and much of Asia.
The President of the United States out on message on what has been coined Bidenomics, and the usual political debate. I saw one Lawrence Kudlow last night going after Bidenomics, and I'm sure there's others out there supporting Bidenomics. Maybe it's something that'll get some traction here, but that's the time we are in the cycle here, where we're trotting out phrases and trying to see if they'll stick against the wall. Bidenomics is with us, and of course that is for one America, a prosperous America. As we noted earlier, Apple, we're on the $3 trillion watch, futures up 13. The yields are there, the real estate market. Katie Craigfeld with us, with Lisa and John out today. I mean, Katie, come on, the real estate market is supposed to be gloomy, terrible, we're all going to die. And I think the housing data this week's actually been pretty good.
And what did Powell say? Didn't he call the bottom in the housing market, or just about? And I mean, the data would support him. We're going to get another piece of the puzzle at 8:30. So we'll see how
listen to you. You're
that
prepared
goes.
for this.
I'm prepared. I did a lot of homework.
Pharaoh's never prepared.
No, I don't believe that.
I do. We get more housing data coming up.
We get, what is it? Pending home sales, I believe. We got
there we are, 10 a.m. this morning.
Oh, there you go.
You'll still be on air. Catherine Geifeld with us here this morning with Bramo and John out. Futures up 13. Again, usually what we would do is talk Bidenomics here, but because she's appeared before on the show with a Yankees jacket, we're going to rip up the script and flip the set. Joining us now, Chief Bloomberg Surveillance Yankees fan, Anne-Marie Horton. Anne-Marie, my youth, and I do not remember this game, wise guy. I do not remember Don Larson, 1956. but I remember the emotion of David Wells, the clinical nature of David Cohn in 1999. That was an extraordinary effort. And then yesterday we see a perfect game, the fourth Yankee with a perfect game. It resurrects the season, doesn't it?
Oh, it certainly does. And really an incredible moment also for Mr. Haman, given the fact that he just lost his uncle 2 days ago. And I bring this up because he really talked about it. He said he's been grieving and he's been crying, but he felt his presence there. And you have to imagine what kind of pressure you're under. At the same time, you're grieving a loved one, and you're able to pitch a perfect game. Just an incredible game. Unfortunately, I was sleeping because I was coming on your show this morning.
That's what you like.
So I had to make sure I got I had to make sure I was getting to bed. But obviously watching the clips this morning, just
superb.
Spectacular.
Thank you for the Team Yankees coverage, surveillance coverage. Doug from Florida emails in and says, don't forget Sandy. Sandy had a perfect game as well. Let us move on. This is a president who is struggling. Bloomberg reporting last night that it's a completely normal medical condition where it's about apnea, and I guess it's a really serious thing, Anne-Marie, nothing to make a joke about, except it's front and center in the politics of our nation, isn't it?
Well, it is. So the president has declared that he had this over a decade ago, so we've known about that. But now he's using a device which has straps on it and puts indents on his face. So yesterday, reporters were talking about what's wrong with the president. You can see there was some sort of machine or an allergic reaction or something, and then we were the first to report that he was using this device. But it brings to heart the question about the president's age. He is the oldest U.S. president in history. He's 80 years old. When you look at the polls, even amongst Democrats, which Greg Valliere was pointing at in the last hour, that they are concerned that he is too old. On top of that, he had a really rough 24 hours when it comes to a number of gaffes. Twice in 24 hours, he confused the country of Ukraine with Iraq. And as well as that, when he was talking to donors, he says he has a, quote, new best friend, and happens to be the largest populated country in the world, China, and he was talking about India. He corrected himself, but obviously when he makes these moments, even though he has been prone to gaffes for his entire political career for decades, it does bring to the surface these concerns, not just within the electorate, but within the Democratic Party about his age.
And of course, those are concerns for Biden, the candidate, as well. And listening to him speak yesterday, in a lot of ways, it was a campaign speech. And when you think about Bidenomics and that term that has now been coined, it seems like that's really going to be a plank of his candidacy, the economy.
Yeah, so the administration, the campaign, they clearly see the polls, and it's that Americans do not rate this president when it comes to the economy. And that is definitely because of high inflation. What they're trying to do is go out and tout their legislative wins. And part of that, what that means for how Biden sees a growth in industrial manufacturing in America, about bringing jobs home. He talks about he wants to be a union president, about making sure that they're securing supply chains away from China. What's interesting is when the term first came about, Biden had said, I don't know what the hell that is. That's what his quote was, joking to an audience of union workers. So it was the Wall Street Journal, I believe, that first talked about it.